GETCRACK. Wake up, motherfucker.
Rebounding this morning, but the S&P is coming off a 3-day negative streak, poised to snap a 6-week win streak. The NASDAQ is positive for the week, as I mentioned, but not the S&P and Dow. Joining us on set is Jefferies Chief Market Strategist, David Zervos. Do you pay attention to these things? Term premium?
Absolutely.
Yeah, what does that tell you?
I think it's normalizing, Sarah. I'm excited about it. I think we went through a period where disinflation and deflation risks were really a big part of particularly liability managers' exercise of thinking about what was going to happen if you stayed at low yields for too long, which is something we did pre-COVID. And now we're more balanced. We've had kind of a pretty big inflation shock in the last few years. And so it's more balanced. So term premiums to me are more balanced. That's still a low term premium by 20 to 30 year standards. Term premiums used to be much higher. We only got to these negative term premiums after a decade plus of missing our inflation targets.
So it's not a
deficit
supply story?
I don't think so.
Because that's last time it rose, that was sort of the concern around treasuries.
I think people have really overplayed this debt deficit story. Every CEO, every big, trader on Wall Street, that's all they want to talk about. Like, we're overextended, our kids can never pay this back. You know what the reality is? Our debt to GDP ratio has actually come down from 133% at the peak in 2021 when we jumped it up to deal with 15 million people being unemployed very quickly because of COVID. It's all the way back to 120. And it's headed lower because growth has been so strong. So I know it's not back to 105, which is where we started in 2019 before COVID.
But we're in a high growth period, so it should...
High nominal growth. And a lot of it is we've inflated a lot of that away. Well, not after we went to war with COVID. I mean, you look at the amount that our debt to GDP went up. It went from 105 to 133. That looks like something that happened in World War II or World War I. We're back to 120. I feel really good about that. And I also, I guess, at the end of the day, if we were going to have debt and deficit problems, the whole years of the post-GFC, we took debt to GDP from 60 to 105. We almost doubled our debt to GDP ratio, particularly under the Obama administrations, both of them. When did we have any problem with yields? When did we have any discussions about debt and deficit?
But we had incredibly low rates during that period. Interest costs did not bubble up as a huge issue, which now you hear $1 trillion and it gets your attention.
Yeah, $1 trillion relative to a $29 trillion economy, which back then was a $16 trillion economy. So I think you got to put that in percentage of GDP, which is always important. But I think it's overblown.
Janet Yellen a little, doesn't he?
Yeah, I mean, you do. You and Janet Yellen are the only ones not worried about the deficit right now.
I think it's overblown. I don't worry about it as much. I think there's lots of other things to worry about, but that's not
like what?
Top on my priority
What are you primarily
list.
Worried about?
What am I primarily worried about? I'm primarily worried about, I think from the fiscal side, I just worry about the government crowding out the private sector. This is what I don't like. I don't like big government coming in and doing effectively what Japan has done for 30 years, which is push the private sector out, have a big debt to GDP ratio, and basically make it harder for businesses to be productive and entrepreneurial. That I don't like. So I would like to see smaller government. That's why I would prefer smaller deficits and debt. But I don't really worry about like a debt crisis. I just think it creates, lower growth. I think it creates a more government-run economy.
You think our corporates are not dominant enough?
I would love
on a global basis?
Less regulation, less government involvement in business, and I think that's
this is a political statement you're making.
I just think that's a better economy for us. I think that's a better economy for us. I think it, I am making a statement about regulation.
U.S. companies are crushing their global competitors.
Yeah,
crushing them.
And we should keep doing that. We should keep doing that. There's nothing wrong with that. That's fantastic. We are still the best place to put capital to work in the world, and we should be even better. I think we could be even better.
So do you think the market rallies whoever wins the election?
I think the resolution of uncertainty is key, Sarah. So to the extent that we get a quick verdict, I think it's good for the market. Anything extended, I worry about. And that is another worry I was going to bring up when you asked me worries. I don't like what happened in August with liquidity. I didn't like what happened with the VIX, the Nikkei, and a very small macro story, like 100,000 payroll miss and a BOJ meeting that wasn't really that eventful. And all of a sudden, the Nikkei has the worst day since 1987, and the VIX shoots up to March of 2020. I think the plumbing of our markets actually has some problems. I'm not sure what they are, but I didn't like what I saw in August, and I don't want to see a period coming out of this election where we're all, waiting days or weeks or months for resolution. I think we could see people put their hands up liquidity-wise and maybe get air pockets. That worries me.
That's a real possibility.
It is a real possibility.
But don't you think then the Fed would just look to ease 2 times instead of maybe 1, or maybe another bigger ease if that happens?
I think it would certainly tip the scales that way, and the markets would think that way. But again, I just think that drawn-out period of uncertainty, especially if it's, constitutional crises kind of stuff, just gets everybody's risk-off juices flowing. And I'm not sure the Fed really solves that with an extra 25 here or there. That's my worry. I don't think it's as high a probability event as I probably would have worried about it maybe 2 or 3 weeks or months ago, but that's probably one of my biggest short-term worries. So that's why I took the late shift with you guys after midnight about Englewood Cliffs on election night, because I think there's probably more to talk about later rather than earlier.
I'm just going to show up the next morning.
I don't think there's a lot to talk about from 8 o'clock to 12 o'clock at night.
Exactly.
So, but I know you guys are running that from here.
Figure it out, though. Don't worry.
I'm going to go to New Jersey, and maybe we'll have some more fun once all the West Coast closes. We can talk about Nevada and all that
I think
stuff.
AP called about 26 races right away, maybe another 5 an hour later. But the important ones, it'll be a while.
Yeah.
Well, it'll be good to have you on board either way, David. Thank you.
Thanks for having me.
David Zervos of Jefferies.
For more on what to expect from big tech next week, let's bring in Jefferies analyst Brent Thill. Brent, great to have you with us. I'm going to pick up exactly where we left off, and that is Alphabet, because you think that Alphabet's actually the most controversial name because it's got to prove that what it's spending on is worth it. What are you looking to hear this quarter?
Yeah, good afternoon. Thanks for having me. Google has had the worst sentiment of all the names going in. So the setup is better because everyone is so negative. As Tim pointed out, the multiple is super low. It's trading at a low teen EBITDA multiple, which again is very, very cheap relative to historic. I think the big concern around, are they going to monetize AI? What happens to search? What's the new CFO going to say? Google has been a company that has literally given investors no outlook, no milestones, nothing that they're going to hit. They're like, either you invest in us because you believe in this, but we are not going to give you anything, financial analysts. Google, Meta, Microsoft, everyone else gives mile markers. So I think everyone's been, hey, I can't really understand this. And it's no doubt why the sentiment's so poor. So we're looking for clues around, will the CFO change the outlook and the way that they've guided historically? No one's expecting a lot. And ultimately, the health of search has been good. Advertiser checks have been good. So I think it's more around how are they going to monetize AI? What's happening in core search? Are these new AI assistants that we're all using, are they taking away from our ability to go to Google? We don't think that's happened. Obviously, YouTube's a big focus. We think YouTube's doing very well. So overall, we think a lot of the negativity is priced in, and we would agree it's definitely has the lowest expectation going in.
What are the markets that you want to hear from Google when it comes to monetizing AI? I'm curious as to, what the advertising is like and what they make on, let's say, an advertisement that's placed next to a Gemini, answer to a query versus in the traditional search business.
Yeah, I think we'd love to hear that. I think the big thing, you just want to hear that core search is good. We're obviously in an election year. You have a lot of online spend. You have, is the strength that can continue. Many advertisers are worried about a Q1 hangover because we have such a robust advertising market. What's going to happen? They don't typically give us an outlook on that. But I think if core search stays solid, YouTube is good, and they continue to demonstrate inroads in AI with Gemini, which we think they are. And again, we're really early. We're like bottom of the first inning, maybe even bottom of the first inning. It's so early. So I think as long as it's not terrible and core search is okay and ad budgets look good, stock should be okay from here.
Brent, do you find that we're getting to a valuation time period with these names, or are we still just focused on AI? Because Google could be considered cheap, NVIDIA could be expensive, but are we not there yet? Is it still AI centric?
we're not. I mean, you look at NVIDIA and Microsoft trading at 30 times earnings. These are not, .com, internet, cloud. Palantir is trading at 30 times revenue. We have NVIDIA and Microsoft trading at 30 times earnings. So I don't believe we've hit this bubble. Second, there's no mass rip-roaring IPO market, right? We're not seeing that. We're not seeing huge multiples. My entire industry, which mainly is software, the multiples have only compressed and gone into energy, gone into financials. We've seen actually in our desk more money moving out of tech into other sectors, given the rip we've had in semis. So I don't think we are in a bubble from what we can tell across multiple fronts. We don't see it yet. The question, and you guys raised it earlier, was on CapEx. Every investor we meet with globally is like, when are all these dollars? If Amazon and Microsoft next year spend $80 billion in CapEx, how do I know we're getting a return? We're seeing a backlog. We're seeing it in customer stories. We're seeing the adoption of some of these new products. It's early, but every board and every CEO in America is talking about how they embrace AI. I don't care if you sell farming equipment or you're the most technologically advanced healthcare company. Every single CEO, and I've never seen boards in 25 years of history doing this, they are absolutely freaked. They weren't freaked about crypto. They weren't freaked about the internet. They weren't freaked about other technology shifts. They are freaked about this, and they're getting in front of it.
Payroll. Stephanie Roth of Wolf Research saying this: we're looking for 70K on payrolls. Despite being bullish on the economy, we expect significant noise in the report. Stephanie joins us now for more. Stephanie, good morning.
Good morning.
You are bottom of the survey here at Bloomberg, and I think that was unexpected for you, 70,000. So I know you're not bearish. So let's just start with the 70 and tell us what's gone into that. What's the process that you and the team went through? How'd you end up at 70?
Sure, it's actually kind of simple. So the trend in payrolls growth is somewhere around 150,000, right? So that's a decent trend in payrolls growth, similar to where we were last cycle. Then you've got to knock out 33,000 from Boeing. And then our estimate for the payroll for the payrolls impact from hurricane is about 50,000, which is in line with historical hurricanes of the past. So that gets you to something that's pretty weak, even though the underlying trend is just fine.
So claims came out yesterday. They're back to pre-hurricane levels. What does that tell you, if anything at all, about what we might see next week?
Yeah, so you saw about 4,000 increase from Florida. It's possible you'll see another increase for next week. If not, then it might tell you that our number's a little bit low and the hurricane had less of an impact than we thought. But even you had Governor Waller the other day out saying the combined impact from Boeing and the hurricanes could be 100,000.
Stephanie, what if you add in the basic revisions that people now slice off the non-farm payrolls report because we know about the data being difficult and noisy? Say you take 60,000 off. Is that included in your 70? Or if you take 60,000 off, maybe we'll get 10,000 for the NFP?
Well, so one thing to note is that in the revisions, and we saw positive revisions in the last print, we should probably see positive 2-month revisions in the next print as well, because you typically get positive revisions in the month of August and September on both the first and second prints.
Sounds like you think 70 is actually a good number for next week. Is that a good number?
I think it's fine because if in fact the hurricane number is kind of correct when we look at the state data and we can confirm it was driven by Florida, then it's totally fine and the market shouldn't be scared of it.
What's the kind of number the Fed might be scared of? And by scared, I mean sit there and say perhaps we shouldn't cut interest rates by 25 basis points.
I mean, I think they could take Governor Waller's number, 100,000, knock that off the trend. So call it something below 50,000 would really get a lot of attention. The BLS also publishes the number of strikers, so you can easily add that one back.
No, I'm asking what would stop them from cutting at all, not going from 25 to 50. What would make them sit there and say, this jobs market is way stronger than we thought it was. Unemployment was climbing through the summer. We got nervous. We did a big Jackson Hole speech with Chairman Powell, came out and cut interest rates 50 basis points. Here we are a few months later, 10-year yields are up by 60 basis points, and the 2-month average for payrolls is 200K. Should they be cutting interest rates?
Oh, it's such a tough one. I mean, I think it's really hard for them to not cut in November. In December, it's fairly likely they'll skip. So I think they'll probably just want to see a little bit more data. And then by December, it's very reasonable that they would want to pause for a meeting.
But Stephanie, he's asking for a number. Is it 200,000? What is that number look like?
Yeah, I think it's 200,000.
The line in the sand.
That's probably the line in the sand.
But you think that skip might come in December?
I think it's more likely December than November. But it's fair. I mean, and you should also start to see a little bit of headwinds from an inflation perspective from the hurricanes. That starts to put a little bit of upward pressure
So
in the
your
next couple
number
months.
for next Friday is 70, but as we said at the top, you aren't bearish, you're bullish. So walk me through what you're looking for through year end and into next year. What do these numbers look like for jobs, for inflation, and ultimately for the Fed's landing?
Yeah, so for jobs, we think that the trend is that 150,000. Forget about the next print that's filled with a lot of noise. But beyond that, something like around 100,000. We're looking for soft landing type prints, so inflation roughly around 2%, probably a little bit above, and you'll have a little bit of upward pressure in the next couple months just from hurricanes, so autos should see some upward pressure. That's a soft landing type of economy. We went from over the summer thinking it was hard landing, then the market narrative was soft landing, then it became no landing, and the result is probably somewhere in the middle where it's soft landing. That said, the no landing has probably not run its course yet. We're not quite out of the woods from
What does that mean? What does the no landing hasn't run its course yet? What does that mean?
That there's still probably upward pressure on rates in the near term. Combination of election uncertainty, pricing in the potential odds of Trump significantly raising up the deficit, and realistically both sides putting upward pressure on rates. So the no landing, I think, really manifests itself through interest rates. So that's probably where we would see it in the near term.
Mic off.
Okay, I didn't get anything out of that at all. Welcome, shalom. It is Shabbat, Friday evening going to Saturday. This is what we get for chief economists nowadays, huh? Nice airhead opinion there. Now, next week, less than a week at this point, we will have Halloween, and we will have our contest. So please donate to Portia and put in the message that money is earmarked for the pot, where we'll have at least 13 ladies compete in costumes to be the winner of our first annual Halloween contest. So here's our ad. I'll play it.
This Halloween, it's time to turn up the heat and bring those spooky vibes. The John Galt YouTube channel is hosting the ultimate sexy Halloween costume contest, and you could win over $300 in cash. That's right, first place takes home the biggest prize. But don't worry, second and third place will still score big. It's easy to enter. Dress to impress, flaunt your most creative, sexy, or daring costume, and show up to the live stream during the evening of October 31st, which is a Thursday. Come on over on Halloween and flaunt your very best and enter your chance to win the grand prize. Let your imagination run wild. You can be a witch, a vampire, a ghost, a nurse, a cheerleader, anything goes. The more unique and bold, the better. Winners will be crowned based on creativity, style, and those spooky Halloween vibes. The John Galt community will decide who takes home the glory. So what are you waiting for? Get your costumes ready now and come on over to win that prize on the John Galt YouTube channel. Hit that subscribe button, follow the contest rules, and you could be walking away with cash and bragging rights. This Halloween is not just about tricks and treats. It's about winning big on the YouTube channel, The Urban Landlord. It's the only place doing this. Let's have some fun, let's have some laughs, and let's have a spooky good old time. See you there.
Yeah. So Iran, yes, got bombed, and no, there was no pipeline. Apparently, the IDF decided to only target military sites. So you can watch some. Let's see what I got here. I think this is the only coverage we have right now.
In response to months of continuous attacks from the regime in Iran against the State of Israel, right now, the Israel Defense Forces is conducting precise strikes on military targets in Iran. The regime in Iran and its proxies in the region have been relentlessly attacking Israel since October 7th on 7 fronts, including direct attacks from Iranian soil. Like every other sovereign country in the world, the State of Israel has the right and the duty to respond. Our defensive and offensive capabilities are fully mobilized. We will do whatever necessary to defend the State of Israel and the people of Israel.
Yes, 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 yes. After Sukkot, I think it was, so Sukkot ended around Tuesday, so it is time to buy stocks again. And I would, however, caution, that's why I was playing some of those videos earlier, that it probably will take a long time to get the counts done for some battleground states, and there's already rumors flying that it'll take at least 3 days, maybe a week, maybe more. So during that period where nobody knows who's the president, yeah, stock market will not like that. But as far as the Congress is concerned, I think the House and Senate races are almost locked in. So if Trump does win, yeah, I believe the Senate races, yeah, should go towards the GOP. So that's a lock. House probably can swing to the GOP. So then, yeah, that'll be quite. That's pretty much why the bond market has been selling off. They won't like uniparty control. It's just going to be too easy to pass bills and affect spending in a way that swings too far on one side. So, I mean, I want to replay the first video.
Stocks are rebounding this morning
because this last part,
maybe 2 or 3 weeks or months ago, but I
think
this, constitutional crises kind.
Yeah, blah blah.
It is a real possibility. But we're all,
Okay, this part here where he's talking about the
small.
liquidity.
I don't. Uncertainty is key, Sarah. So to the solution of uncertainty is key, Sarah. So to the extent that we get a quick verdict, I think it's good for the market. Anything extended, I worry about. And that is another worry I was going to bring up when you asked me worries. I don't like what happened in August with liquidity. I didn't like what happened with the VIX, the Nikkei, and a very small macro story, like 100,000 payroll miss and a BOJ meeting that wasn't really that.
So during that time, we also had like the unwind of the yen carry trade. So this part here is worrisome.
Eventful, and all of a sudden, the Nikkei has the worst day since 1987, and the VIX shoots up to March of 2020. I think the plumbing of our markets actually has some problems.
Yeah, well, there's definitely some problem. We won't find out until it actually happens. So be aware, could be some volatility coming down the pike. So if I think next week goes well for all the big tech earnings, then I would hedge or protect yourself going into election, because I don't think it will be resolved quickly. And then you got this little factoid where
I'm not sure what they are. But
I think Sarah
would think that
here,
way, but
see what Sarah says.
Get
to Sarah.
My worry. I would have worried about it maybe 2 or 3 weeks or months ago, but that's probably one of my biggest short-term worries. So that's why I took the late shift with you guys after midnight about Englewood Cliffs on election night, because I think there's probably more to talk about later rather than earlier.
I'm just going to show up the next morning.
I don't think there's a lot to talk about, like from 8 o'clock to 12 o'clock at night.
Exactly.
So, but I know you guys are running that from here.
Figure it out, though. Don't worry.
I'm going to go to New Jersey, and maybe we'll have some more fun once all the West Coast closes. We can talk about Nevada and all.
Yeah, I think AP called about 26 races right away, maybe another 5 an hour later. but the important ones, it'll be a while.
Yeah.
Okay, where the heck was that comment from
here or there.
Sarah said something
especially
right here.
And the Fed would just.
Okay, right here.
I think we could see people put their hands up liquidity-wise and maybe get air pockets. That worries me.
That's a real possibility.
It is a real possibility.
But don't you think then the Fed would just look to ease 2 times instead of maybe 1, or maybe?
So if the election is not settled and the market goes crazy, she's implying that the Fed will do a 50 basis cut. Just off of that. Now, if that happens, holy shit, I would just buy every crap in stock that goes down at that point.
Another bigger ease if that happens?
I think it would certainly tip the scales that way, and the markets would think that way. But again, I just think that drawn out period of uncertainty.
Yeah. So be prepared. I mean, I'll be bullish until through next week. And then from that point on, I would not know what to say about how long it'll take to count ballots. That's really something I can't predict. So be aware of that. Now, let's get to some serious business. Okay. I don't know if that strike on Iran did anything to Bitcoin. That's the only market we have open right now. And Israel always likes to do this. They always like to attack over a weekend. It always seems to be their thing. They like to screw you around during the weekend, so when you wake up on Monday, people just start flipping out. But they didn't blow up any pipelines, so I don't know. I guess my oil stuff won't go up. Let's see what natural gas will do. Natural gas did well today. Very nice. Let's see natural gas. Yeah, it's still moving up from that area. So still holding my boil that I rebought at below 9 to 8 here. Okay, let's see if it gets above 10. Then I'll just through Halloween. Then I'll decide if I sell it again. Okay. Anyway, silver EXK. Yeah, I sold a chunk on Monday and Tuesday, holding the rest. Not sure how that's going to go. Silver miner EXK and gold. Well, after the attack tonight, I guess Monday will be good for gold. Maybe. And let's see what else. Palantir. Oh, yes. Palantir today did quite nicely. 3%. And we're going to have a lot of Palantir videos tonight that I'll show. And let's see what else is good to cover. Yeah, 3 stocks in particular had earnings, and that pushed the NASDAQ up. And I'll talk about that. But as you can see, like, it faded it. So that's the candle. Open, went up, and then fell back for the NASDAQ 100. So we were kind of trying to get to the new high, but we didn't make it. And if you look at semiconductors, you see we hit, like, if you did a trade like on NASDAQ or semiconductors, like you bought here on this blue line, you see that was tested back in October. And Friday the 13th was kind of where it made that high. Yeah, you would have bought here. You would have sold a bit on the pump on Thursday. And then sold some more here. And I'm probably going to leave the rest. So I bought SOX L around there. And, I got here 32-ish. I'm pretty damn close to the bottom. Sold some at the open the next following day, 34.7. Sold some more on the open here, 36.7. And I'm just holding the rest for next week. So we'll see how that goes. I'm not going to be so optimistic on semis. I mean, the only thing that's major is AMD. So that's it. But everything else before Intel. Intel will be Thursday, but that'll be too late. By that point, we'll have all the other major earnings from big tech. So let's show that. Actually, let me show that. because you guys need to know what is in big tech. For earnings, because we have a lot of earnings to go through. Yeah, so I put on something here to listen to right here. Yep, right here. So Monday, for semiconductors, probably on semiconductors, ON, but that's not that big. Then Monday afternoon, we'll have Cadence. So that's CDNS and Rambus RMBS, but also probably not going to be much. Then you have Amcor. Yeah, these guys, AMKN, these guys are not going to affect it too much. And then Tuesday morning, you'll have BP. They'll be one of the big oil companies that'll report. And, Royal Caribbean. Oh, yeah, this cruise liner stock is really nice. RCL, actually. Once the COVID reopened, that stock went nicely. Boomers love cruises. SoFi, that's the top one. Also, probably something PayPal. You might want to look at those too. And you have McDonald's, Pfizer, PFE, JetBlue, the last airline to report, major airline. Spirit Airlines, I think, reported today. I think it jumped up, but Spirit is such trash that, of course, it just jumps up on anything. But Tuesday afternoon, AMD, Google. Those are two big ones to watch. And then you have Snapchat, another crap company that's good for gamblers. So if you like to gamble on earnings, I showed that chart before. It's a schizophrenic chart. You want to gamble on that, you get that. And you have Chipotle, CMG. Yeah, nothing else that's interesting. I guess Innovix. That's a small company. I probably will watch that one. Then Wednesday before open, you got Eli Lilly, one of my favorite stocks, LLY, pharmaceutical. Then you have like an industrial, pretty popular one, Caterpillar, CAT. And you have a insurance company, health insurance, HUM, Humana. So those are the big ones. Jinko Solar, Chinese solar company, JNKS. Yes, that one I look at from time to time. Nothing to invest in, but something to look at when you're gauging how strong the solar market is and how much production China does. It's definitely something you can gamble on, but it's a pretty trash stock. Actually, I might go over in phase. I'll show you like that chart. It had earnings this week, terrible. So the whole solar sector is just decimated. It's the worst performing sector out there right now. Then Wednesday after the close, you got Microsoft, MSFT, Meta, META, so Facebook, Instagram right there. So those two for Wednesday afternoon. So remember, Tuesday afternoon, AMD and Alphabet, Google. Then Wednesday afternoon, Microsoft and Meta. And then you have Robinhood and Coinbase, Coin, COIN, and Robinhood, HOOD. Check that out. And you have another solar stock, Nova, SunNova, NOVA. So that's trash. And one of my favorites to look at is CVNA, Carvana. Oh man, that one was a missed opportunity. I bought Carvana at the lows around $4. I sold way too early. I did not know used cars would keep on trucking that well. And that company was such a bad company too. So it was hard to believe that they could just turn it around so quickly. Okay, Thursday before open, you got Uber. UBER, Uber. And man, Peloton still hasn't gone bankrupt. Okay. You got Peloton, PTON, and Merck, nice pharmaceutical stock, MRK. Okay. And ConocoPhillips, another oil company reporting, very big one, COP. Oh, beer company, Altria. My bad. And I gotta go get that link again. Sorry. Let me put it back. All right. Yes, right back here. Altria, MO, beer company, big beer company, and you have another cruise liner, Norwegian Cruise Line, smaller one, NCLH. Then Thursday after the close, you have Amazon, AMZN, Apple, AAPL, Intel, INTC, big three. That's what we got to watch. Okay, guys. And then after that, Friday morning, 5:30 a.m. my time, 8:30 Eastern, we will have payrolls data, which was the last video I just showed, where that chief economist, she was trying to explain what the heck was going to happen, and I think it was not clear at all what's going to happen. So if the stock market does go up into Thursday and you don't feel like taking the chance of Amazon, Apple, Intel all reporting at once, and then in the early morning, before 1 hour before the market opens, you get payrolls data for September, and you don't want to take the chance, yeah, you better get out then. But if you want to hold it all the way through Friday, yeah, go ahead. Because that Friday, if it pops up on all good news from Amazon, Apple, Intel, and, well, Intel, it's definitely going to be bad news. But if the bad news from Intel isn't as bad as people think, then yeah, it'll pop too. And the whole NASDAQ will go up, take the S&P up, and we'll be fine. And also in the morning, we'll have Chevron, CVX, and ExxonMobil, XOM, to end the week. That will end the week. Now you'll have some other ones to look at, like Fubo, so FUBO on Friday morning, and Roku, ROKU. So anybody into TV, yeah, you can look at those stocks. Some of those are quite interesting in the, in earnings season. So that's it. Now let's play this video here about Boeing and Intel.
Has a new piece in the Wall Street Journal titled "Crisis at Boeing and Intel Are a National Emergency." He writes that the companies underscore a fundamental problem, that the U.S. still designs the world's most innovative products, but it's losing the knack for making them. Joining us right now is Greg Epp. He's the Journal's deputy economics editor and chief economics commentator. And Greg, I think you're right. This is a national emergency. What's to be done about it? Or maybe before we get to what's to be done, describe what happened.
Well, if you go back a generation, Becky, and you looked at a list of the most admired manufacturers in America, you would have had Intel and Boeing pretty near the top of that list. You probably would have also had General Electric. And it's really just sad and shocking what's happened all three in the last 25 years. GE is a shadow of its former self. Intel is struggling to compete with TSMC in Taiwan. And Boeing, well, I mean, the story speaks for itself. It's just struggling. It's not crazy any longer to talk about breakup or bankruptcy. And the point I'm trying to make here, Becky, is this isn't just an issue for shareholders. It's an issue for the country. These countries epitomize what was once the greatest part of American manufacturing. They didn't just make any products. They made the world's most advanced products, which had vastly positive spin-offs for the economy and our national security. If we lose any of those companies, I think it's very troubling for the country.
What are we to do? I mean, the CHIPS Act was supposed to help Intel and make sure that we were manufacturing chips in this country. Boeing, I think you make the excellent point that neither of these companies are doing this because of cheap imports coming from overseas. These are self-inflicted wounds on both these companies.
I think it's easier to say what we shouldn't do than what we should do. I don't think that like an across-the-board tariff is going to be of any help to these companies. There are manufacturers that actually rely on imported inputs, and so they could actually be harmed by a trade war in that respect. Fundamentally, turning these companies around is a job for management and shareholders. The one common thread in a lot of these companies is that they succumb to the financialization culture. They were obsessed with like the share price, with earnings per share. They didn't invest patiently in long-term projects. Boeing decided to try and like upgrade the old 737 instead of launching a whole new airplane. Intel said no to like making the chip for the iPhone. That's number one. What's the role for government? I firmly believe that the best thing Washington can do is make sure the world's best manufacturers have a presence here. That's what the CHIPS Act is actually doing. It's handing subsidies not just to Intel and Micron, but also to TSMC and Samsung, which are two magnificent semiconductor manufacturers. As their presence grows in the United States, that helps bring up the local ability. It helps the local supply chain. Another issue I'm going to mention is this takeover bid for U.S. Steel by Nippon Steel. Both presidential candidates oppose that bid because they think that it'll be bad for the unionized workers. But think about it. Nippon Steel is one of the world's best steel makers. Don't you want that kind of expertise hand in hand, working with American workers, American management to make the best steel here in the United States?
Yeah, that seems like it would make sense. You point out that this is financial incentives that were structured the wrong way that caused these companies to basically get greedy and not think about the long term. This started under CEOs long before the current CEOs in both of those companies. Where is the retribution for those who started it? I mean, there's been no clawbacks at either company. There's been no kind of anything other than shame on you for making wrong calls and making the wrong decisions. How about the shareholders and the pushback that they might be able to generate? I guess it's easier to just sell and walk away, but where are the repercussions?
You know, books could be written. In fact, books have been written about the mistakes that were made by the managers and CEOs of these companies. I don't have a lot to offer to that. I think shareholders need to look at themselves in the mirror here. Their obsession with getting the share price higher all the time, pressuring management to hit earnings targets, buy back stock instead of investing for the long term. Look, you only have to contrast the attitude at these companies and their investor base with, say, for example, Tesla, right? Or Amazon, right? These are companies that lost boatloads of money for years, but investors gave them a really long rope because they believed in the vision of the founder that you build a great business with a vision on the earnings you want to make 5 to 10 years from now, not in the next quarter or the second quarter. And when I see that Kelly Ortberg is talking about bringing management back to Boeing's factory floors, when I see Boeing say they're going to sell stock and the stock rallies, that's encouraging because it tells me that management and shareholders are starting to think long term instead of focusing on the next quarter. And I think the union has a role to play here too. They, you know, with some justification, say that Boeing got brought down by the mistakes of managers. But look, they're in this together. What good is the best contract in the world if the company that gives it to you is struggling to be around 10 or 15?
Right. Well, okay. That's an abrupt end for that video. Okay. Now, towards the end of this presentation, I'm going to talk about scanning. That was the main point of doing this. And it will be kind of, I guess we're going to work through it, you know? I don't know how much I'll do it over the weekend, but we're just going to build something basic, step by step. And towards the end of it, into next month, we should have something very advanced that can look for patterns. So search for stocks that we want to buy. Okay. But for now, I want to turn to AI. It's basically what is all the rage right now, AI. And let's go for there. Because I want to get into Palantir again. Because that's my favorite stock. So let's look at OpenAI. Let's look at this video. OpenAI.
OpenAI's new head of global affairs, Chris Lehane, laying out his vision for what government should do to keep American AI on top in an op-ed today. Our Deirdre Bosa sat down exclusively with Lehane for today's Tech Check. Deirdre, what does he say?
Well, Kelly, also, I just want to make the point that this regulation is happening a lot differently for this era of technology. Sam Altman, OpenAI, they seem to have learned the lessons from the social media era. That has partnered with Washington early on, bring on the right people with policy experience, and there are few people better positioned to do that and chart out a strategy than Chris Lehane. After working as a political strategist in the Clinton White House, he came west working with local regulators at Airbnb, then in crypto, now leading policy at OpenAI at a time when the industry and government are all trying to get their arms around AI policy. He told me that the stakes in AI are higher than anything else that he's seen, the autocratic versus the democratic development of it.
Look, China's head has talked about the idea that they want to be the dominant player in AI by 2030. Vladimir Putin, who I would typically never ever quote, has said that whoever wins AI wins the world. And so the stakes here are enormous. And for the U.S., which is currently leading, but that lead is not guaranteed, but for the U.S. to continue to lead in AI and therefore help ensure that it's actually built with democratic values, democratic principles, drives democratic benefits.
Now, we still don't have specifics on either presidential candidate's tech policy. So Chris Lehane and other policy executives in Silicon Valley, they're going to continue and they're going to be playing major roles in whatever AI regulation is ultimately shaped or not shaped. Here are some of the names to watch. You've got Jay Carney, who went from the Obama White House to Amazon and now Airbnb. Google's James Manyika, Lisa Jackson at Apple. The faces on your screen, Kelly, they're the new policy heavyweights in tech, no matter the outcome of the presidential contest. My full interview with Chris Lehane is available on the Tech Check podcast. Back to you.
It's great that you sat down with him, Deirdre, and I find it interesting to watch the aspect of don't pay attention to how we do business, just know we're vital for national security and kind of, see our significance that way. Deirdre, thanks for bringing that to
that we forget. Almost everybody in the AI world is American.
CNBC just dropped a jaw-dropping interview with Alex Karp. You have to check this out.
And then almost everyone who's doing kind of munitions and targeting at scale with hardware and software is also American. And another advantage we have is we can just transform our industry because we have exceedingly agile CEOs and work environments, unlike Europe. And so what we're basically seeing across the legislative and DoD is people saying, wait a minute, we need to do a lot more of this. We need to see partnerships.
Speaking of agile work environments, I mean, you just talked about the fact that you have this next program. One of the things in this release, you're going to hit your cost-saving targets a year early.
Right.
You are also a commercial customer of Palantir.
Absolutely.
As well. So when at a time where more broadly investors and company CEOs are saying, okay, application layer of AI, where's it going to go in my company?
Collaboration is key. But the urgency Karp highlights is equally crucial. The push for rapid AI deployment in the military isn't just a trend, it's a strategic necessity. If the U.S. doesn't speed up these partnerships, rivals like China could outpace us in crucial tech capabilities.
How am I going to deploy it? How much am I going to invest? And most importantly, what's my return on investment going to look like? What are you seeing at L3Harris?
We're seeing great progress. So we've laid out a transformation of the company. We call it LHX Next. First phase was really focused on cost takeout. We're going to meet those goals, beat them, and exceed them. The second phase is transforming the company, right? And in the old days, you just blow up your system, spend hundreds of millions of dollars, and shut everything down for years. We have hundreds of systems, ERP systems, finance, labor, manufacturing. The Foundry product has the ability to extract the data, knit it together, and get it to us in real time. So we're getting data timely and accurate. We're able to make data-based decisions. It ultimately leads to a better company, more agile company, more profitable. It's been a great partnership. This is something that's going to change for the benefit of the shareholders and our customers.
Palantir, third best company, third best performer in the S&P 500, even though it's a new entrant. A lot of analysts don't necessarily fully understand, I think, what you do on all aspects, but investors certainly seem to get it, particularly on the commercial side. I realize there's been a reacceleration in the U.S. government business, but the commercial business is really what's propelling the stock. What are you seeing, especially as you do have these artificial intelligence platform boot camps and adoption levels?
If you want to manage large language models or AI, the infrastructure that allows you to manage them is where the actual value is. The large language model is essentially a commodity that you can value and use depending on cost and veracity. And they completely don't get it. But you know who does get it? Our commercial American customers. And despite the fact that we barely have a sales team and that I'm providing my pontifications of truth, including America's a great country, which many of them don't like, our allies deserve protection, Israel is in the right, whatever is pissing them off, they're still buying the product. And the reason they're buying it is because our ontology and our AIP allow you to deploy and use AI in a way where it changes your margins, it changes your go-to-market, it changes your ability to kill or take out adversaries in a much safer way with much lower costs. And American companies are dynamic and interesting and run by some of the best people in the world.
Alex makes a critical point here. The agility of American companies, especially in tech, isn't just about innovation. It's about having the freedom to take risks. That's a distinct advantage when compared to more heavily regulated markets like Europe. The ability to pivot quickly could be a game changer when it comes to integrating AI in defense.
Some of whom are much better at partying cooler than you'd ever imagine on TV, and they adopt. And so, it's like, do you want to believe what the librarian says about a book, or do you want to go out in the world and see if it works? And we are in the business of making our commercial customers work. And sure, yeah, we have a ton of player haters. Keep hating on us. Yeah.
Okay.
Player haters. You're going to play a hate? No, you can't play a hate on Palantir.
I was going to say, final question for both of you, really. I'm not going to get into the election specifically, but when you look out to 2025, no matter what that outcome looks like, what are the key areas, whether it's regulation, whether it's defense spending, whether it's something else, what are the key areas of policy that are going to need to be addressed?
Well, look, I've said it before, the whole ecosystem needs to be on a wartime footing, right? We need a budget. I've said before on the show, China and Russia don't have continuing resolutions. We need a budget. We need the DoD to award contracts quicker. I don't care if they're commercial or traditional defense. I think there's huge opportunities to allow our company and other companies to be treated as a commercial enterprise. Everybody in DoD and DC loves commercial companies. Put out the RFP, let us propose, make a decision, and let's move quickly. And then, of course, we have all in industry have been building up capacity. There's not enough capacity in the defense industrial base for the demand that we need. So I think let's get a budget, let's make some awards, give us a chance to execute. I think the future is hardware, software, and AI. I think we're well positioned for the long term. I couldn't be more excited to be here with Alex and be a partner of Palantir.
How do you bring violence to our enemies while using ethical standards that the West believes in? So when do you attack? Under what conditions do you attack? Do you attack if there's civilians? How many civilians? In what area? What radius to schools? How do you make sure that the people we're hitting are our actual adversaries? How do you take out this dumb, but leave the intelligent generals alive that are kind of misaligned with their own country and take out the idiots, or vice versa? These things are really important decisions. And then for Americans watching this, Americans want to know that their dollar spent is a dollar well spent, whether that's in the DoD or any other place.
Karp's point resonates with the increasing demand for accountability. As taxpayers, we expect transparency and efficiency, especially when it comes to defense spending. Palantir's involvement in AI for defense shows a promising direction for using technology to not only enhance capabilities, but also to justify every dollar spent.
So commercial entities, commercial companies that are also patriotic, or in our case, patriotic first and commercial equally, are important also for the integrity of our country. Every single person is wondering, okay, of course I want the best war system in the world, and I want something our adversaries couldn't replicate. What did it cost? What were the margins? Did it work? Is this something that is commercially viable? Would a commercial entity ever buy this? Those are very legitimate and important questions for the integrity of our society, and our partnership goes a long way to answering them, because quite frankly, there are some rooms where I'm more welcome, mostly people who are investors in Palantir, or often, in many cases, on the battlefield, and there are some rooms where they would rather talk to Chris, and I'd rather have them talk to whoever they'd rather talk to. We need to get the best products on the battlefield, and that often requires partnership.
Karp's emphasis on partnerships shows the reality of modern defense. No single company can do it all. When Palantir collaborates with other entities, it's not just about selling software. It's about leveraging different strengths to deliver the best possible outcome for the military. It's a strategic necessity, especially in AI, where innovation moves quickly, and collaboration often determines who leads and who follows.
What are the lessons learned, to the extent you can talk about them, about AI deployed on the battlefield? I think about the Middle East, where CENTCOM's using Maven. Palantir's involved in that program. It's now being deployed to other parts of the world as well. Just today, the White House issuing this national security memorandum on AI, talking about that, the fact that they need more AI deployed more quickly to the warfighter in military context, but that there need to be guardrails in place as well.
When we took over Maven, it was, I mean, AI was viewed as a joke. We took it over because Silicon Valley notoriously thinks the job of Silicon Valley is to get rich first and to not support our warfighters. So we took that over, and then what the DoD, and I'm very happy to see Jake Sullivan writing about, it's very important, has learned is the being able to identify and take out our adversaries in a way that's more precise, quicker, and more lethal.
This precision-based approach to AI-driven warfare is where Palantir can really differentiate itself. The ability to rapidly process and act on intelligence data means making smarter decisions on the battlefield. But we need to ask, how do we maintain that edge if other nations start adopting similar technology?
Than anyone else in the world gives us a structural advantage. America and the way we organize things is something we are willing to fight for. And then once you've articulated we are going to fight for our way of life, a lot of decisions follow. And then how do you fight for it in the DoD context? Well, if hardware, software, hybrid AI is our advantage, then maybe you should look at, like, okay, well, who are the people who do it? Buying software and AI from somebody who's never built any system that's ever worked, or buying it from a PowerPoint, or not having a commercial vendor preference is literally suicide. So, but the first thing is to say, and then I would start renaming things. It's like, I don't understand why we have a Department of Defense. We should have a Department of Offense. And the other, I personally believe like we have to have red lines, and then we should go ahead and violate them to show people how serious we are. Like, why do we wait till our enemies attack? It makes no sense. It does not lead to peace. You have this famous thing, it's a paradox of thrift, where if you oversave, you get poorer, which every progressive learns. It's tattooed on our bodies. There's a paradox of violence.
The paradox Karp mentions is a controversial yet thought-provoking concept. It challenges the conventional view of deterrence. The argument suggests that showing strength through decisive action, even preemptively, could actually lead to a more stable world. But how do we draw the line between necessary force and excessive aggression?
If you never use violence, the world gets more violent. And so we need patriotism and competence and a willingness to use violence. And I don't know why we wait till people get up and hurt us, kidnap us. And last not least, as I've said over and over, if you touch an American citizen, we will go after you. We'll go after your assets. We'll go after everything. We'll keep on going for generations. We cannot allow people to just kidnap and kill Americans wantonly and then say we're going to have a memorandum at the United Nations, essentially an academic institution that pushes papers for despots. So we really need to change our footing on this. And by the way, we're in a position to do it because our economy is the strongest in the world. We're the only people producing AI. We have the best CEOs in the world, and we have the best warfighters in the world.
Karp's comments about American readiness and AI integration leave us with a crucial question. Are we truly prepared to lead the next wave of technological warfare? It's not just about having the best tools or the smartest people. It's about creating a culture that's willing to use these advantages when it matters most. As we look to the future, the U.S. must decide whether it wants to remain on the defensive or take a more proactive stance in shaping global security. This isn't just about AI. It's about redefining what it means to be a world leader in the 21st century.
Man, looks like this guy wants to punch everyone out on the world stage. And we have BRICS. I think BRICS added at least 13 more countries over the week. So yeah, we're gonna have something going on. Definitely. So let's see what AI Palantir's up to.
The state of the world today is that you just cannot rely on GPS anymore to do your flights. Using visual navigation to provide an alternate GPS source in areas where there may be conflict. This is Palantir software running on commercial hardware, so we've partnered with some really great drone companies where we're able to provide this joint demonstration, and then we're also tying it back into the rest of the Palantir platform.
Everything that you're going to see up on the screen is running on a little compute device like this. This is an NVIDIA Jetson Orin. This is just an off-the-shelf consumer-grade USB camera in a 3D printed housing that we just stuck to the drone to use for R&D. So all this is very configurable, hot swappable, depending on your mission needs. All of this is then going to feed into the visual navigation algorithm, which will be running the positioning when you don't have GPS. The first component is the telemetry coming off the drone. This is stuff like the compass information, the accelerometers, the barometer that gives you the altitude of the drone. All this stuff the drone produces naturally as it flies. The second component is what's known as optical flow or visual odometry. So this is a technique where you watch the motion of the video feed coming off the camera. So frame, 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 moving left to right. You can see if the video is moving left to right, the drone is also moving left to right. By applying some mathematical transforms to that data, you can extract the speed, the velocity of the drone and use that to calculate the drone's position over time. By combining these two things together, you can say, okay, I knew the drone was here. 10 seconds later, it's going to be over here. For short navigation, that might be all you need. And indeed, this is where a lot of other companies doing visual sorts of navigation work stop there. It works over short distances, but as you go over time, little inaccuracies build up, and where you were within 2 meters to start, now you're within 20 meters, now you're 100 meters, now you're completely lost. So you need something else to fix this. That's where the third component comes in. This is what we call our reference matching technology. So the basic idea is simple. You take images coming off the drone and you match them up with pre-rendered satellite imagery that you've collected. And by using computer vision, you can determine where those images align, and from that extract where the position of the drone must be. Easy to say, hard to do in practice. And this is where the special magic of the component comes in, because this is able to, over time, correct whatever drift you build up in the drone position from those other components. So you can fly miles and miles, and since you're always checking your position against the map, you don't get off course, you don't drift, you stay locked on target. So all these three data sources then come into what's known as a Kalman filter, which is a mathematical construct for combining different sorts of sensor data and giving you the best result out. This will then tell us where we think the drone is, and from there we can send messages to the drone controller to say this is where you are, and the drone controller then gets to decide how to control the drone to navigate the pre-programmed mission.
So in this specific scenario, the target is right outside of a known GPS jamming site. So the nice thing about having this software on board is we're able to fly directly through that zone. Even though we're getting our GPS jammed and compromised, we're able to fly through it because we're going to switch on our GPS visual navigation software and actually use that as an alternate GPS source and not rely on this other source that's going to be unreliable because of the jamming going on. The green areas are showing known GPS jamming sites. These are obviously what we're very focused on today. The orange areas are showing known area defense zones. So this is going to be where there's surface-to-air missile sites. There's other sorts of air defense systems that are planted there. And then there's some other intelligence data that we have layered on here. What we're showing now is actually this drone and proposed flights through this battle space and through this area. It's proposing us these different flight options, and we can kind of look through this and see what we think is best. Now we're showing some wind forecasts and we're showing some weather data coming into this that we can also incorporate into this model and into our analysis here. Once we're comfortable with this and we're actually good with this flight path through this area, what we can do is, and you'll start to see, is we can package this up and then actually like push it out onto the drone.
All right, we are now watching the onboard recording of the drone as it flies through the mission. So what you're seeing in the top left is the video feed coming directly from the drone. This is the feed we're using for visual navigation. That's being matched against the top right, which is our satellite data that we've loaded on the drone in advance. You can see all these green lines showing where the algorithm has identified tie points between these two sets of imagery. As it progresses, you're going to see the match is strong right now. There'll be phases where it gets a little weaker, goes yellow, we lose it entirely, goes red. And through all of this, the algorithm is going to use the different data sources available to it, so telemetry, optical flow, reference match, to keep the drone on track as one or the other source becomes unreliable. A lot of consumer hardware is designed around the assumption of GPS, which gives a certain signal quality. When you're doing a live visual navigation flight profile, it needs to control a little bit differently, so you end up with a bit more wobble in the flight path, but it's still locked on target. It's still making its way to the destination. You can see we've turned the corner. We're flying over a natural environment once again with a mix of trails, but we're about to leave this natural environment and hit a man-made parking lot style environment. We've now finished our mission here. You can see down at the bottom, we have the profile of how strong our reference lock was from time to time. We're now descending, and in just a moment, we're going to switch back to manual control to land the drone safely.
All right, the next video will be a bit longer. Let's see how much we can get through it. Let's see how interesting it is. And then after that, we'll end with AI for hospitals. So that'll be it for hospitals.
In warfare, reliance on GPS technology can be a fatal flaw. As we've seen on the battlefield, even the most advanced AI-powered drones can become lost or compromised when facing sophisticated electronic warfare. But what if there was a solution that could keep drones on target, even in GPS-denied environments? Join us as we dive into how Palantir's visual navigation, VNav technology, could revolutionize drone operations.
So we covered that. So let's see what new information.
Ensuring they navigate with precision even when conventional systems fail. Welcome back to our channel. Today we're exploring a pressing issue in modern warfare, the unreliability of GPS technology on the battlefield. In recent reports, including insights from the Wall Street Journal, we've learned that US-made drones are struggling to overcome Russian jamming and GPS blackout technology. It's a stark reminder that GPS signals can be jammed, spoofed, or completely denied, leaving drones vulnerable in combat situations. Advanced electronic warfare capabilities can easily disrupt these signals, leading to drones losing their way or even worse, falling into enemy hands. Using radio control to operate drones in these scenarios is equally risky. It's easily detectable, which can expose operators to enemy attacks. But here's where things get interesting. What if drones didn't need GPS at all? That's where VNav comes in. To address these challenges, Palantir has developed visual navigation, or VNav. This groundbreaking technology allows drones to operate autonomously in GPS-compromised areas. By utilizing onboard intelligence and software, VNav enables drones to navigate accurately without relying on GPS or radio control. It does this through a simple camera and onboard compute, comparing the drone's position against satellite imagery. This capability gives drones enhanced mission flexibility, allowing them to operate in environments where GPS is not just unreliable, but completely unavailable. Think urban canyons, dense forests, or even inside buildings. For missions involving reconnaissance, surveillance, or deliveries, the ability to navigate through varied terrains without relying on external signals can be a game changer. And there's more. The cost efficiency of VNav could change how drones are used across industries. Palantir has partnered with Flyby Robotics to showcase the power of VNav. Their F-11 drone model integrates seamlessly with this technology, ensuring operational compliance and reliability. Palantir has spent years developing products at the intersection of computer vision and geospatial algorithms. VNav is the culmination of that expertise, combining multiple data sources to provide a comprehensive picture of the drone's position. One major advantage of VNav is its cost efficiency. Traditional navigation systems that rely heavily on high-precision IMUs or complex sensor arrays can be prohibitively expensive, especially for large-scale deployments. VNav, however, leverages standard, often lower-cost sensors found in many consumer drones and enhances their capabilities with advanced software. This makes autonomous navigation technology more accessible by reducing the cost barrier, enabling broader deployment across various sectors, including military, agriculture, logistics, and infrastructure inspection. But the benefits don't stop at cost. What about scaling this technology for diverse use cases? VNav scalability is a standout feature. Because the system integrates with existing drone hardware and requires minimal additional components, it can be easily scaled for different use cases. Whether used in military drones for defense operations or commercial drones for tasks like crop monitoring and package delivery, VNav's adaptable design broadens its market potential. This scalability opens up new applications while maintaining the same core technology, allowing Palantir to push the boundaries of what's possible across industries. Security is also a significant concern in modern drone technology, with GPS signals increasingly vulnerable to spoofing or hacking. VNav mitigates these risks by eliminating the need for GPS signals altogether, drastically reducing the chance of an adversary hijacking the drone's navigation system. This capability is especially crucial for national security applications where robust cyber defenses are essential. Palantir's solution enhances mission security while ensuring the drones stay on course, even in hostile environments where electronic countermeasures are in play. Environmentally, VNav contributes to more efficient drone operations by enabling safer, low-altitude flight, which reduces energy consumption. Lower power requirements translate into longer flight times and less frequent battery replacements, making it not only a cost-effective solution, but also an environmentally friendly one. The reduced need for continuous signal transmission also minimizes electromagnetic interference, benefiting surrounding ecosystems and reducing the drone's overall environmental footprint. Ease of use is another strong point for VNav. Many current drone navigation systems require specialized training and familiarity with complex GPS-based technologies. VNav simplifies this by using visual navigation techniques that are intuitive for operators to understand. This can significantly reduce the training time for new pilots, making drone operations more accessible and easier to integrate into existing workflows. The use of familiar visual navigation techniques means operators can get up to speed faster and perform missions with greater confidence. While VNav uses live camera feeds for navigation, it does so without storing or transmitting personal information, addressing privacy concerns that often arise with drone operations. This makes it a compelling choice for civilian applications where data protection and privacy are paramount, such as in urban monitoring, infrastructure inspection, or public safety operations. Palantir's design ensures that sensitive information remains secure while still providing the capabilities needed for autonomous navigation. What about future potential? The groundwork laid by VNav opens up exciting possibilities for AI integration. Looking to the future, VNav's foundational technology can serve as a stepping stone for integrating more advanced AI functionalities. For instance, future updates could enable features like real-time object avoidance, adaptive mission planning, or even fully autonomous decision-making without human intervention. These advancements would enhance the drone's ability to perform complex missions with high levels of autonomy and efficiency, pushing the limits of what's achievable in both military and commercial applications. For commercial users, VNav's technology can also help in meeting regulatory requirements for drone operations. Its GPS-independent navigation capability makes it suitable for scenarios where traditional navigation might not comply with regulations, such as flying near buildings or in densely populated areas. By offering a solution that aligns with or even exceeds current regulatory standards, Palantir makes it easier for commercial operators to navigate the complex world of drone regulations and expand their operational capabilities. In disaster response scenarios where GPS infrastructure might be compromised, VNav-equipped drones could prove invaluable. Whether it's for search and rescue missions, damage assessment, or delivering emergency supplies, the ability to operate autonomously in GPS-denied environments could be the difference between life and death. The technology's reliability in adverse conditions showcases its potential for humanitarian efforts, making it an essential tool in the arsenal for disaster management teams. Furthermore, VNav isn't just a standalone solution. It can be integrated with other technologies to create a broader ecosystem for enhanced mission capability. For instance, combining VNav with mesh networks for drone swarms could enable collaborative missions where multiple drones work together autonomously. This integration potential opens the door to even more sophisticated applications, from large-scale environmental monitoring to complex military operations. To sum it all up, VNav's revolutionary approach to drone navigation is more than just a technological innovation. It's a leap forward in redefining what's possible for autonomous systems. By merging multiple data sources like inertial sensors, optical flow, and reference matching into a cohesive system and using advanced algorithms like the Kalman filter, VNav offers a robust, reliable navigation solution. Palantir's commitment to pushing boundaries is evident in VNav's ability to overcome the traditional limitations of GPS-based navigation, providing a safer, more efficient, and more
the work we've done, whether it's like determining eligibility for hospital at home at Mount Sinai, or some of the work we're doing with Tampa General around sepsis, it really boils down to like understanding these pretty complex sets of rules across the healthcare system, and then transforming those into a way that can be evaluated against the like unstructured and semi-structured patient data to say, okay, this patient meets this particular eligibility for hospital at home, or concern for sepsis, or Keytruda from a reimbursement perspective on the back end. And there's a real like heterogeneity problem in healthcare where you can't represent every possible combination of circumstances in one discrete field in the EMR. That's when large language models and AI become very useful, where like a little bit of machine reasoning goes a long way to avoid the need to codify each individual node within the health system. And I think like creating this like immense amount of like structure and like the network connecting the guideline to the particular part of the chart that's used to trigger the guideline is the thing that allows us to like operationalize these large language models. And historically, the medical record has had a monopoly at the point of care, and it's like almost like heresy to suggest any other software should be involved. But I think as we move forward and as we like understand like how we can deploy AI into reimagining some of these workflows, I think could you at the same time have the clinical evaluation, which we showed in that like Keytruda example, right next to the billing example, and it's getting very specific about the work that needs to get done based on not just like the intuition of each physician, but the actual empirical research that has been done to understand how we should treat these patients. And closing the loop on the empirical research is tremendously difficult. Like even for academic institutions that produce the research, like they can't operationalize to close the loop on the research.
On your last comment, which is this is why.
All right. Nice ad there for their technology. And the NHS is using Palantir tech at this moment. So I think as healthcare gets more and more complex, from the insurance side to the clinical side to everywhere, the lab side, managing big organizations will require AI, and Palantir is the way to go. So keep pumping my stock, guys. Keep pumping it. So we're going to go to our lessons today. I'm going to start with this one. I mentioned DeMark indicators before. So I'm going to try to do a little intro on it using these two videos. And we shall see how this goes. We shall see.
Possibly fading the try to time it exactly right. They're very willing to take some healthy profits on names that I've been long since mid-December. Excuse me. So this is just one of the models we look at, and again, you can learn more about it. You can look at some stuff online, but if you tune into the last 3 webcasts that we've done for stock charts over the last 3 weeks, I walk you through this model and show you some of the implications of signals that show up. Now, part of In the Know Trader 2 is trying to get you to think more like an institutional trader. And it doesn't happen overnight. It takes time. And part of it is kind of potentially opening your eyes to new and different ways of looking at the markets than a pure 100% technical way, which many people do, especially who are stock charts viewers. They're technicians, and yes, I'm a technician, but I'm also a market timer and I'm kind of a behavioral market specialist. So I'm looking for all different signs of what could possibly be the end of a trend that people will not understand or realize is the end of the trend. The move down in December, even here, if we take a look at the S&P, we know that it took out here. I'll make it, I'll put an ellipse around or something. So here's the February low that it held for the whole year until we broke down in December. And the breaking down, the severity of the breakdown made everybody say, okay, I don't want to say everybody, made many people think we're in a bear market. I've been telling clients for over a month, we are not in a bear market. We were never in a bear market on this move. And this overshot to the downside actually just minimally broke our downside target of 2371 by about 1%. And the day after it does that, the Dow or the S&P rallied, I think it was 115 points. The Dow rallied 1,000 points. And, you know, we were in print to saying this is a low, a solid low, but I can't tell you it's the low until mid-January. I came across a different chart, and I think I have it here. Let me see. No, it's in.
I got a question while you're looking this up, Rick.
Yep.
You know, I can see all those numbers in there, almost like counts. Is this similar to Elliott Wave?
No, it's
not at all.
It's actually not at all.
Okay.
So the counts you're seeing here are actually relationships, and it's simple math. The counts are simple math. It's relationship between price bars. A 9-count up, and this is a monthly chart of the ACWI All World Index ex-US. This, I'm just using this as an example, but you'll see anytime you go 9 consecutive price bars, in this case it's months, so 9 consecutive months that the close at the last trading day of the month is above the close from 4 months prior, the bar gets a number to it. And it's looking for this to happen 9 consecutive times. If any time along the way, any one of these closes is not above the close from 4 bars back, the numbers drop off, and you actually get a 1 showing up underneath the price bar, suggesting that this close is less than the close from 4 bars back. In order to do this phase of this DeMark model, you've got to minimally go 9 consecutive price bars, close above close from 4 months ago. In the case of a monthly chart, that's often all a market moves before it gets some type of pullback. You don't necessarily know how much it is, but it helps identify, again, potentially a lousy time to be a buyer in an uptrend. The same thing here on the downside that marked the low. Hold on, let me pull this down so we can get the dates in here. Do a little more. So here in 2016, when the market sold off, this happened to conclude 9 consecutive months that the closing price in this ETF, ACWX, was less than the close from 4 months prior. And we move up, we go sideways, but it's only until this part here in 2017 that you actually go 9 months close above the close from 4 back. And we did extend a little beyond that. But what made me turn very bullish in January and help conclude that there was no bear market and there is no bear market coming is that this ETF, which represents the All Country World Index minus the US, right? So this is basically all of Europe and all of Asia, the best markets there. Whereas the US didn't break really until the end of the year. The rest of the world was kind of selling off the whole year of 2018. And we actually got down to 9 consecutive months, starting January, that the close was less than the close from 4 months prior. That happening against the uptrend line that came from the 2009 low, against another element of this DeMark model, which is this horizontal line, said to me right in here that there is very high chance that there is no bear market and whatever decline Europe and Asia had seen is done. So while many technicians are looking to sell into the rally and saying, you know, we've broken down, we took out the February low in the US and keep looking for places to be sellers, all I'm saying to people is we need to find places to be buyers. And when I cut down to shorter term, and that's, for instance, the S&P chart I showed initially, I can see that at least on a daily chart, we're getting closer to upside exhaustion here, which doesn't mean you sell everything in the house, but that you do want to perhaps take some profits. We've had a huge run in the market since the December bottom, and that we may very well be close to a peak, which you would not see in many other indicators. In fact, I'll tell you that this particular model is, as far as I'm concerned, the single most accurate model there is to calling a trend exhaustion as close to the actual turning point as there is in all of technical analysis. Now, does this model always get it right? Absolutely not. Not a chance. But is there anything that even comes as close to this model and be able to call turns? To my knowledge, no. And I know hundreds of technical indicators. Anything that's based on a moving average is never going to call the turn exactly when the turn comes.
Hey, Rick, do you ever use any, and I'm sorry to interrupt you, but do you ever use any sentiment indicators?
Okay. Now, remember that point where he said, like, when it had a downtrend going to the 9 count here, hitting that trend line, he said he was a buyer. When most other people were ready to keep on selling, that 9 count signaled a turn. Okay, I'm going to go show a video of the creator of this indicator, Tom DeMark, okay? And you'll see, this is from the 80s now. This is a throwback. I think you'll find it interesting because it's quite similar, huh?
I got to tell you, the Japanese yen, just in my familiarity with people in the hedge fund business, there are a lot of people trading the currency. I mean, the currency market is well over $100 billion a day. This is where all the action is. This is where all the big players are. They use leverage. There have been a lot of people hurt in this market this year. And if they had used this simple technique, they wouldn't have been hurt. They would have been on the right side of the market. There are people who have gone out of business with billions of dollars actually selling, which is a trend, into these 9 lows when they should have been buying. But let me show you. This is somewhat inactive back in June. We should probably use a September contract, but it would apply. The same thing because I was there. This closed greater than 4 trading days earlier, but we did a series of 9. And what happened? The market turned here. Now, what I like to look at, and this is not in the book, I stress that. This is important. For a setup, if you want to maybe trade these 9s, day 9 should be less than the low. The low, if you're looking for a buy setup, the low on that particular day should be less than the low of day 8, day 7, but more importantly, day 6. And I'll show you why as this thing unfolds, because this is something that what happens, it's still a good low, but what happens, if you're not less than, specifically, the day 9's low is not less than the low of day 6, you have another day down over and over again. It seems to reappear more and more, where the market just finally cleans everybody out. And I'll say, for example, if this low on 9 had been greater than 6, you would have seen another day down, and then it would have turned, if it was going to turn on a 9. But let's just go through these now. So you got a 9 here, it's just a low close. That's another thing, too. When you start looking at charts, after a while, if someone held a chart up over there, provided I could see that far, I'd pick out the 9s. I can just see them. My mind is just focused right on 9s. I mean, this is my baby, and I can see it anywhere. I can almost feel it. You know, the 9s just appear over and over again. Or someone came to me, a couple weeks ago in Chicago when I spoke to the Chicago Mercantile Exchange, said, here's a 9. I just looked at the chart. I said, there's no 9 there. Yeah, there is. Look. There wasn't. It was off by a tick. You just get a sense for it after a while. Now, one thing I want to stress before we go on, though, too, these are 9 consecutive, bold print, consecutive closes less than the trading close, so the close 4 trading days earlier. Not less than or equal to. Don't get caught up in this with less. Well, this one's equal, so I'm going to count it. Don't use the equals. And we'll show you examples where the equals should not be. This is in a setup. But I'm also going to show you an improvement to the sequential countdown where you do use equals. It's not in the book, and it's a real enhancement. And I'll show you example after example. We'll go from one to the other. Where I use equal, and this thing is calling the precise high, but because you're using you're using greater than for the countdown or less than for the countdown. This is not part of the setup. You're missing trades. But as far as the setup's concerned, you do not use equals. It's got to be less than for a buy setup. It's got to be greater than for a sell setup. But here, going through this 9 was less than 6, so you're all right. The market's moving up. Do you want to do a training mode? I'll show you one feature of this system. They've set up a training mode, so you can follow this day by day. You can see it unfolding. There's 9 over there. You got a 200-point move here.
This is the 9 you're talking about right here.
Yeah, just keep going this way. But you got a 9. You got to play here. I mean, this is 9,600 and 9,750. It's 150 points on $1,250 per point. That's about $1,900. Okay, here's a 2. He's just going to take you right through it. It's a great training session right here, which maybe you might want to look at later just to get an appreciation for how it's defining it. 1, 2, 3, 4, 5, 6, 7, 8. Canceled it out. Why did we cancel it out? We had 8 consecutive closes greater than the close 4 trading days earlier. I'm going to get a 9. Oh, I'm all excited I'm going to get a 9. What happens? This particular close here is less than the trading close 1, 2, 3, 4. What is happening, and I see this in the market's regenerating.
That's an equal close there.
Is it equal? Okay,
Yeah.
It's equal close. What the market's doing, it's regenerating. It's really building power. If it had gone straight up with 9, you're probably going to get a short-term peak, what I call a stutter in the market. The market's going to take its breath and come down. This particular case, hey, the market said, and I'll tell you, just from my own experience, I've got 2 close friends who use this religiously. One's at one of the major mutual funds in the country. He's been top 5 in performance this year. And as far as timing, he uses exclusively this. He doesn't know all the nuances that you people are going to know, but he obviously has an appreciation for it. The other fellow is one of the major hedge funds. We've seen it time after time where this equal, for example, in this setup was enough just to cancel it. And you sit there and you'll watch the markets. On the close, the market will play around this point so many times, it'll just gravitate to this level. And it takes on a meaning. There's a real significance there. There's dynamics within the market that I can't express, I can't explain, but they're there. Now, in this particular case, you cancel that 8 setup, sell setup, because you only, with the 8 sell setup, as opposed to 9, you cancel that movement.
We can go back to that. Here's the 7.
Okay, there's 7. You can see that. There's 8. It's greater than 4, not. Now this close is greater. It's got to be greater because it's the 1 there.
Yeah. With all this, I'm sure it is because of the scaling that we're having to do with this position.
Now up here, this is your first close, greater than the close 4 trading days earlier. There's 2, there's 3, there's 4, there's 5. Gone. Why is it gone? Because this close is less than the close 4 days earlier. The market's moving higher, and it's fooling a lot of people. Everybody's bearish. I mean, Japanese yen, first time post-history, is above $1. No one believes it. You see the pullback, But I'm looking at it and say, hey, you got to do a 9 at least to the upside. There's a 1.
Sorry. We're continuing to go higher.
Okay, 1, 2.
We were down here.
Yeah.
And we continue to move higher. I had it off the chart.
Okay. There's a 1 and 2 down. There's a 1 up, 2, 3, 4. This will just give you an appreciation for the setup. Now here in this one here, now it's regenerating again. 2 and a 3. There's 6, there's 7. Nope, there's a 1 up. There. Now we're going to do some business. Hopefully make a low. This is when? What period of time? August.
It's August of this year.
I remember this in August there was a low. There's a 1, 2, 3, 4, 5, 6, 7, 8, 9. That 9's low was less than those.
Less than the 6.
Less than the 6, the whole set. Similar to the one we had back earlier in the year. And what the market did, it took off. This is when a number of the major hedge funds sold. And they got killed in this. There it goes. That's a big one. That's when you went close to new all-time highs. You're moving up there quick. Now, there's the 8th again. Same thing. Market said, no, I'm not ready to top out. I'm going to give you a pullback. I'm going to stutter. And that's what it's doing. Prices, you pull back. Now you're going to regenerate again, I think. Well, you're moving sideways now. Hold on. It's going to do it again. Nope. 3, 4, 5. 1 for a buy setup, 2 for a buy setup, 1 for a sell setup, 2 for sell setup, 1. Back and forth, back and forth. There we go. 4, 5, 6, 1, 2. See, it's just there. 6, 7, 8. Next one. Hope we get a 9. Okay, this 9 is above the 6. And that's important. I watched that one at this low. And they said, is it going to do a 9 in turn, or is it going to do on the full countdown? And like I said, I'll show you later how we hopefully increase the odds of distinguishing between whether a 9 is going to be a low or whether you're going to go to fulfillment, which is the countdown. But in this particular case, you can see the 9 was not less than the 6. The 6 is the real key day. I told you before 7, 8, or 9. 6 is the real key day, like Rick said. What it told me is that you got one more day down. And you got it right there. Right here, day after. And then that's you have to get below 6. You probably would have put a sometime in this zone, you would have said, hey, there, you're at the low. And now, keep going. And that's when you had that strong move to the upside. It was virtually uncontested. I mean, the market just took off. And this is where you caught the hedge fund guys short. Now, there's a 9 again. Look at this one. Same thing, the reverse of that. Where we said before the 9 had to be less than the 6, the 9 has to be greater than the 6. It wasn't even greater than 7 and 8, so you knew you're going to make one more thrust up here.
Greater than the high.
Greater than the high. The 9's high had to be greater than the 6's high. Conversely, at the low, the 9's low had to be less than the 6 low. See, over here it wasn't. 9 was not less than 6. The reverse of that would be high greater than high of 6. High of 9 greater than high of 6. And it wasn't. What happened? You made one more thrust when you went above the 6, and that's at 104.10 or something like that. And what happened? What did happen? Oh, there. This is very somewhat recent. Yeah, now you're moving it. Now look what's happening here. You had a 1, 2, 3 for a buy setup, consecutive days, 4. Then you did a 1 up, 1, 2, 3, 4. Now I'm dwelling on this because unless you get this basic approach to the setup, the whole concept, you're going to have trouble with the countdown. And you're going to have the trouble with the enhancements.
Yeah, that was interesting. And, very esoteric. Very esoteric. It doesn't matter, tropes. It doesn't matter what the intervals are. Those 9 counts apply anywhere. But usually, yeah, the DeMark indicators are usually used in daily, monthly, weekly. I've rarely seen people try to use them in day trading or whatever. I mean, unless you're an autistic dude with and you got tons of Adderall on you and trying to do all that crap, most people would not use that in day trading. Yeah, I mean, you gotta be Rain Man at that point. But if you want to actually call the exact tops and bottoms to the right point, yeah, you'll need that. You'll probably need that. And if you're well, and if you really care about that stuff, if you DeMark's yeah, it's very advanced topic. I don't want to even get into it right now because a lot of people can't even do the most basic technical analysis. If you really want to know about it, you might have to read this book. Here. I don't have to share the screen. This book. Yeah, read this book. If you want some crazy homework to do, you should read this book. It's from the series Bloomberg Market Essentials Technical Analysis, DeMark Indicators by Jason Pearl. Tom DeMark, the creator of these indicators, has written his own book or books, but most people don't understand it. So, yeah, if you want to learn about DeMark indicators, they just recommend Jason Pearl's book. But this, this book is kind of probably out of date. These indicators have been updated since then, but they give you, a basic idea of what to do. And if you're really interested in those indicators and you don't want to program them yourself, because you read through this whole book, there's plenty more. You can do Elliott wave with D wave counts and all these other fancier techniques. yes, you can go, because before you had to get a Bloomberg terminal and pay tons of money for a package just to get these DeMark indicators, but you're in luck. There is a cheaper version run by his son, and it's web-based. You can go to Symbolink. So here, right here, Symbolink, SYMBOLIK.com. Open a free account, and after you open a free account, you can add a subscription package to DeMark indicators. If you buy the yearly package, it's about $79.99 a month, so $80 a month, $80 a month. I can't tell you if it's worth doing. I've seen people use it, and they say it's pretty solid, so it's almost as good as getting a Bloomberg terminal and paying for the real DeMark indicators that his father made. But if you want the bum version, yeah, you can go get the Symbolink and run by his son, all that there. So yes, go over there, get it, and you shall see pretty good stuff. Let's see what else. I don't know. Let's read through this book a little bit. See, chapter 1, TD sequential. So the 9 count is probably in this section here, the TD setup. Yes, so a bearish TD price flip occurs when the market records a close greater than the close of 4 bars earlier. So that's your counts right there. And yeah, you see the 1 through 9s. Yeah, so that's the basic, and that's just the beginning. That's just the beginning, because once you do 9s, then you have to count to 13. So in the first video, the previous one before the one before the last one I showed, you saw 13 counts. That's just really where the exhaustion comes in. So yeah, I mean, I don't use it much, honestly, because I think you got to really have a full understanding of his methodology. It's pretty complicated. Pretty complicated, but a lot of you guys might find it interesting. Let's see what else is there. So the real lesson for today, after the DeMark introduction, and I might revisit DeMark sometime down the line when I have time, but the first thing is to build the system, okay, and lay the frameworks. And we're just going to use basic technical analysis for that. And from there, you try to use the Wyckoff methodology. And then after you do that, incorporate the cycles. And then after you do that, then we can start thinking about how you would use DeMark in these cases. So that's my goal. The DeMark is at the end of doing all the laying all the groundwork. So the first groundwork is the scanning. That's what the whole lesson of today is. So let's do some basic stuff and go to stock charts. So I'm using the stock chart scanner. Okay. Okay, I have industry summary and sector summary. Okay. And then the scanner here. All right. I'm setting it up right now for you guys. Okay. put on some music. Okay, add this back. All right, guys. So in stockcharts.com, there is something called a scanner, okay? And you got to pay a subscription to get into the scanning engine and edit your own scanners. But I'll show you something here where, they give you a free sample of what the results are every day. So you get these. I think they do it for the close of the day, right? Yeah, the last market close, you see, and then they'll give you some options to do the close for, but limited. You can't do much more than this. So you can do the last close or the last market close. So we can look at, okay, what are the stocks that have the latest new highs? So then you can look and you can sort it with scooter rankings and stuff like that. And I'll go over what a scooter is later today if I got time. But you have the predefined scans here, all done for you. But you can't edit them, you can't change what they are. Okay. Now you also have industry summaries. So you have a list of industries and you have a list of sectors. So these are the 12, I think 12 S&P sectors, or is it 12? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Oh, 11. 11, my bad. 11 in sectors of the S&P 500. And then you have your industries, all part of those sectors. So communication services is XLC right here. And within it, you'll see the little industries in their own category. Okay, and the neat thing is you can go down here and look at what are the stocks in those industries. So let's say I did coal, right? Coal stocks. And then I can look at the industry and I can look at all the coal stocks grouped in that industry. And they're grouped based on the Dow Jones list. Okay, these are not ETFs. These are just grouped by the Dow Jones. That's how they group them. And they'll change what groupings they are. And the Dow Jones, I think, is owned by the S&P 500. The people that run the S&P 500 now anyway. So they all run by the same people. So let's look at computer services. We can look at that. See, you can get all the stocks within that industry. Now, what I'm going to show you now is, let's say I want to scan something, right? So I'm going to do something simple here. Okay, and I'll stop sharing that one and share. Let me pull out my window a bit. Pull out my window. Okay. My bad. And then share this window. Okay. Let's do that. Do it this way. Okay, so you can see what I'm doing here. So this is what Stock Charts does. You see that? So that's the syntax I have right here. So it's pretty simple. So the list of stocks I'm going to sort through, I'm going to scan through, is what's in the S&P 500. And then I'm looking for the 90-day percent relative strength versus the S&P 500. So what I'm looking for is relative strength. And you have to remember, I showed you in the last couple streams, I was looking at a ratio, right? So one ratio I looked at was using what's the semiconductor versus the S&P 500. So I used SMH over SPY. I used the ETF SMH over SPY, or I used SOXX over SPY. I can use either one, either ETF for semiconductors. And then I compared it with FDN over the SPY. And what that was I was trying to find which sectors was the strongest one. Oh, actually, it was over the NASDAQ. My bad. So it was like SMH over QQQ or SOXX over QQQ versus the FDN over the QQQ. And what that showed was that semiconductors was leading the NASDAQ 100 versus the other ones where it was communication stocks or internet web type stocks like Google, Meta, Facebook, Instagram, stuff like that, right? So the semiconductors were the one that's leading. Now here, I'm going to scan through all the 500 stocks. And I'm going to look for which one has the strength of 90 days versus 40 days versus 18 days. So like it's kind of like the slope. All right. So I'm looking at the slope over 90 days, right? Versus the slope of 18 days versus 40 days. I mean, I want to see all of them line up going up. So I want to see a strong trend up relatively. So that means whatever stocks should be stronger than the S&P 500 over a 90-day period, 40-day period, or 18-day period. The slope, essentially, the relative strength. Now, the S&P 500 could be going down, but a stock could still outperform it, right? So it's going down less than the S&P 500. So that slope should be going down at a shallower pace, 18 days, 40 days, 9 days. So either way, I'm just looking at relative strength. Nothing to do with absolute strength, meaning I don't care if it's going up or down. I just want it to outperform the S&P 500. That's all I'm interested in. So that's what this scan does. Now, here's the results. Okay, here's the results. So it's sorted by the percent relative. So United Airlines. So after its earnings, it's the outperformer. Okay, you got United Airlines. What's next? Palantir, my favorite. That's why I was showing all those videos. That's my favorite stock. And then Nvidia. So these are the top three right now. And next one, Carnival Cruise. Remember I mentioned cruise lines and the boomers? So gotta look at the next week. We'll have Royal Caribbean, I believe, right here. So also very nice stock. So all these stocks up here, oh yeah, and GE Vernova, which is a power, basically the one of the third pieces of GE that's got broken out, which focuses on power distribution systems, and I think it has gone up a lot because of the nuclear plans of Google and Amazon and Microsoft. So it's been following the nuclear stocks up, nuclear miners. And we have Norwegian Cruise Line, yeah. Not as good as Royal Caribbean. Royal Caribbean is much more smooth. Carnival, yeah, not as smooth as Royal Caribbean. Royal Caribbean, yes, that chart looks very nice. So you get an idea. Now, the next one I'm doing here is, let's say I'm looking for the weakest stocks, all right? I'm looking for the weakest stocks. So I invert everything. So I do a less than zero here, less than zero. And now I'm sorting the other way. So I'm looking at the weakest stocks. So what's the weakest stocks in the S&P 500 right now, relatively? So these are the worst performers relatively. Enphase, which just reported earnings this week. So renewable energy, not doing well. We got two health. We have the auto parts stock. Actually, I mentioned this one because I was looking up Napa Auto, and I was trying to compare with AutoZone and O'Reilly's. And O'Reilly's and AutoZone was doing much better. And what I figured out was the reason why is because since it's a subsidiary of Genuine Parts, GPC is actually a distributor. So Napa is the retail side of the business, but it's an actual distributor. So AutoZone and O'Reilly are just retailers. They don't care about distribution of parts, but because the distributors of the industry of auto parts are not benefiting from the inflation, the retailers are, though, because they can gouge prices from the consumer, pass it off, take the margin. But the parts guys are screwed, right? Because they actually have to eat the cost in the input side. So, I didn't need to know all that. All I need to do is look at a chart, could tell this business was not doing well, and avoid it. But if you wanted to know the reason why, that's the reason. So, I'm not interested in why, honestly. The chart will tell me what's going to happen. Whether I know why or not doesn't matter. As long as the chart guides me to the right move, the right trade, the right investment, I'm just going to focus my time on reading charts and learning to read them correctly. So that's the goal. That's the goal. The chart should tell you the fundamental story. And even better, it should tell you the insider trading that's happening underneath. It's like we're trying to do Minority Report here. We're trying to do an inverse CSI. You're just trying to figure out the crime before the crime happens. That's the goal. That's the goal. Yeah, Moderno next to week one, and we have others. So First Solar, more of these renewable energy stocks. First Solar, Teradyne. Actually, know about that one. Oh. Hasn't been doing too well recently. Clack, another one. Similar to Teradyne, actually. They're in the same sub-industry in semiconductors. So that's interesting why they're not doing so well. Oh, CVS. Oh, yeah, I'm sure Walgreens is probably down here, too. I mean, Rite Aid went bankrupt, didn't it? Yeah. Walgreens is probably somewhere. I think it's called Boots. I don't know. Boots. Yeah, well, whatever. But yeah, you can see a lot of stocks that are not doing too well. Yeah, some of the oil, definitely that sector is not doing well. Oil this past year. Yeah, they haven't gone anywhere. Anyway, interesting. Okay, next one. So the next scan I did was I blew everything up to have a list of industries. So you remember that industry grouping? I just put it all out here in the scan. So I'm going to look for what's the industry that has the best relative strength. And here I did it over a weekly. So here I'm doing a weekly, so 18 weeks, and I'm doing a slope of the moving average for like 5 weekly for the 18 week SMA, and then the 18 daily SMA 20. So I'm just trying to look for first the relative strength performance, and then the absolute price performance is going up. That's all I'm doing with that. Okay. And this is just trying to give you a flavor, just giving you a flavor of what the scanner can do with just simple syntax like this. You don't need to know any coding. You just need to have some basic intuitive idea, and then understand the syntax that's being written here a little bit. And from there, you can write simple scans. And from here, what's the results? Here's the results. So, asset managers index. Asset managers. So this is the best industry we got going right now. So both from absolute price and relative strength. Financial administration. Coal mining has recently moved up. Pipelines. Yeah, pipelines are always good. Yeah, pipelines. Computer services, defense. Yeah, you got that nice Israeli effect since the summer. U.S. business support services. Home improvement. Yes, right. Home Depot and Lowe's have been doing okay this second half of the year. Telecom equipment, building materials. Life insurance. Yes, insurance companies still doing well. So yeah, you get an idea. And from there, once you know the industry, you can dig down, go into it's in the other window. I can't open it here. But you can go take this list and then try to find out what companies are in this index. Okay. And then once you get that, yeah, you got a bunch of stocks to narrow down and look at. And that's it. That's all you got to do. So it's very simple. You don't need to do too much work, right? You run this every month, or you can do it more often if you have time, every 2 weeks, maybe Maybe every week you can find something this way, and then you can just manage your portfolio that way. So as an investor, this is what you should be doing. Yeah, this is if you want to be an active investor, this is how you should be doing it. Now, what's the next one? Yeah, so this one I'm doing the opposite. I'm trying to find the weakest one. I want to look at stocks that are going down on absolute price, but on the daily, what I'm saying is that like it's turning around. So it's trying to go up. So I'm trying to find the weakest, trashiest sectors, industry groups, and try to find which ones are turning around. So I only got 3: oil, production, exploration, gas, production, exploration. Maybe it's found a bottom. Let's see, because that's what I've been saying too, right? I think oil is about to turn, so this might be true. Steel. China is doing the stimulus, so steel might be turning around too. And non-ferrous metals, meaning uranium, lithium, yes, they're turning as well. So all these are turning, and so that's what I'm saying. I'm just giving you an example of scanning, right? Yes, definitely different than a screener. Screener is too primitive. So that's what I'm trying to get to you guys. Way too primitive, because yeah, so this is a screener in a sense, but oh man, yeah, the screeners you guys are using, like FinViz or Trading View or whatever other, no, it's too primitive. Like just looking at volume of one day or something. Yeah, that's fine if you're looking for a day trade or something like that, but no, you got to move like even more advanced than that, looking for sectors, so yes, we could be very in-depth about it. So I'm going to show another video. This is the Wyckoff stuff. So oh yeah, before I even get to that, oh man, let's go do the homework stuff again. I gotta reintroduce it, because this is the reason I keep bugging people to read their homeworks, because otherwise you're not going to understand the video. So I introduce you to the screener. Now you got to understand the Wyckoff stuff and then put it together, because now we're going to try to make a screener, scanner / whatever you want to call it, and get the Wyckoff in there. So can you scan for Wyckoff structures? Like, is this accumulation? Is it about to pop off? Is it okay? That's a whole nother game. So here, go to this website. Do your homework right there. Yeah, go here. And the first thing I made you guys read at the beginning of this month or end of last month was the first episode. Was Anatomy of a Trading Range by Jim Forte. Okay, that was the first one. Then I told you, I kept bugging people, if you finished it, keep reading it. Like, you got to memorize it, basically. It's got to be second nature to you. You can read the second one, which is basically like the first one, but more up to date. Then you could read the third one, and you could read the presentation, the fifth one. But the number 4 one right here, Wyckoff Power Charting Blog, it's like a book. So you can read the whole blog articles that he wrote, and if you got time. And yeah, it'll give you more examples, try to instill it in you to look at the markets in a Wyckofian manner. After you start looking at charts like that, that's the most important thing, because now I want to scan for the patterns. I want to make the computer do this for me. And the scanner here is primitive, right? It's still primitive, even though like the Trading View one, the FinViz, whichever ones you guys use, even the stock charts one is still weak. Like, you want AI to do this. So that's my goal in the future. Like you got to get the ChatGPT trained on a model and then try to make it read the chart, because it's just like a picture, right? If it's just looking at a chart, it should be able to pattern recognize and go through the whole, if it can read so many charts at once, like just to stuff it with tons of historical charts like big data does, then yeah, it should be able to do this. It should be able to do this. So let's play the video. Let's play the video and see if you guys can understand what the heck is going on. So that's the goal tonight.
One of the questions that I get the most is, how does one scan for Wyckoff method setups? How does one use scanning techniques to identify accumulation, distribution, reaccumulation, and so on? And I am very happy to tell you today that we are devoting the entire episode to the concept of scanning for Wyckoff method setups. We have two very special guests today. Roman Bogomazov, who you know, a friend of the show, my teaching partner at Golden Gate University, Professor Roman. He is here. And somebody who may be new to you, John Colucci, who is an incredible talent and is on scanning for Wyckoff method setups. And John and Roman later this month are going to be conducting a 3-week workshop on how to scan for the Wyckoff method setups. And they are here today to talk about how to do scanning. And then also, they will be talking about the workshop that they're going to be doing later in the month. And so with that, welcome to Power Charting. I am Bruce Fraser, your host. Let's get started. I'd like to start by introducing Roman Bogomazov, who is going to introduce our very special guest for today. Roman, thank you for being here. Welcome to the show.
Bruce, thank you so much. And as always, really happy to be here. And something really special that we have today. And on the background, you guys could see our new website, Wyckoff Analytics website. And behind this website is a big community that we've been building for years and years, starting with Hank, Bruce, and myself at Golden Gate University.
So I'll just chime in, like, if you guys get really into technical analysis, like, and into trading, and you're really serious, you might consider like going to these courses, but they're very pricey. I never been to one myself, and I'm not a serious trader, but from what I've seen, I've went to some of their classes before, the sample classes for free. They do teach very well. I gotta say that. But you don't really need it to make money. But if you're really into trading at a serious level, then yeah. I probably, out of any courses that I've seen, it's probably worth it. But that's up to you. If you want to stroke your ego a bit and try to be the top trader in the world, yeah. Yeah, you'll probably, I would probably say that this is probably the best bang for your buck. But I'm just here to make money. I don't care if I make the most money. So that's up to you guys.
It's really comfortable how
we have a very interesting scan class coming up. Starts on March 19th, goes for 3 sessions. And we are going to cover some of the very critical skills to develop Wyckoff structural scans. Scanning for Wyckoff events and structures is a little different than other types of scanning. We're using more of our concepts and understanding of the interaction of price with support, supply, demand, the laws of Wyckoff. And all of these things provide very interesting opportunities to find actionable entry points for trades long or short. Really a fantastic opportunity to use the resources that Stock Charts provides its customers to use very, very intense concepts to scan for Wyckoff setups. With that, I'll show you briefly, if I may, the Scan for Success Part 2 that we have coming up. We're teaching that course together, Professor Roman and I. We've saved a seat for Professor Bruce, and we may call him off the bench to help us with a couple of the more challenging concepts that we're going to deal with. The 19th, 26th of March and April 2nd are our dates. Please reserve them. We've got a very, very dynamic syllabus for this particular course. We're going to review the things that we learned in part 1. And I do want to say,
well, I mean, education can be a scam too, right? I mean, you could go get a PhD and whatever and make nothing out of it. So that's up to you. Knowledge is what you make of it.
the course is structured so that you can benefit from part 1 even if you don't take, or excuse me, you can benefit from part 2 even if you don't take part 1. You'll find it very, very beneficial. If you have some scanning experience in other engines or some of the predefined scans that are in Stock Charts, you'll find it a very easy transition to take part 2. Part 1 is available on demand, and certainly I recommend that you do take it, but it's not critical. You can succeed with part 2 by itself. The things that we're going to cover in the course will be looking at critical scanning events. How do we select the events that we use to create our scans? What thinking and syntax do we use? We're going to show you how to troubleshoot some scans. We're going to do a little bit of that today. We'll also look at the context of the market in which we're scanning, and that's one of our main themes for today. We have a very much of a down market. And what does that mean for scanning? We'll introduce longer time frame scanning. So those campaigners out there that like the big cause and the big result, we're going to show you how to find those candidates. And with any luck, we're going to get Professor Bruce's thoughts along with Professor Roman's on that particular issue. We're going to introduce the concept of zones of influence, areas where price interacts with support or resistance, and how do we scan in that uncertain area and yet be effective to find what we're looking for. We're going to go through some of the really fantastic ranking and sorting functions that Stock Charts has. Of course, we're going to analyze our scan results, and we're going to also introduce the concept of advanced alerting as a secondary filtering for our watch list. Imagine if you could have Stock Charts scan your watch list for certain price attributes that you feel create a good trade opportunity, and it emails you those every day. Those are the things we're going to cover in depth. And with that, I will note for everybody, we've got a number of blogs up on the site, of course.
The problem is most people won't have time to dig around it, just as Trope said. I spent a lot of time digging through information. But the thing is like, yeah, people just want the efficiency, the convenience. And the other thing too is like you're in a group of other people working together. So that helps you motivate you. So yeah, that's why it's up to you. Everyone's different. Some people, you got the money, go for it. Go through this courses and have people, motivate you to learn it. And I think the other thing too is everyone learns differently. I can learn independently. Some people can't. Right? Like all this stuff I did, I had to learn. I just did it because I felt like learning into it. You know, I didn't need to get motivated or prodded by a classroom. But some people, they need they need more than classes. They actually need extra tutorial courses afterwards, right? You got that after school programs and stuff. Everyone's at a different level when it comes to learning. So I can't say. I can't say. Some people might benefit from these courseworks. Some people might not. And as I say, a lot of people want to be the best trader in the world. So, and they need a lot of practice. And these courses, from what I've seen, a lot of people retake the courses, not because they don't know the material. It's just because they want to keep practicing with people that are high level traders, you know, that people that are at a different level than most that you'll just see online or whatever. That who knows, they just sell you some course and that's it. Because yeah, that's what they usually do. They'll just sell you some slides, they'll give you some techniques, and then they'll say yeah, and then they'll give you maybe 4 hours of their time, and then that's it. That's the end of the course. So I don't know, from what the methodology I've seen from this particular group of people, these teachers, because yeah, I would say these guys are the best at teaching, not only like having the knowledge, but also teaching the knowledge.
Professor Bruce is legendary, and
It's
I'm
so
also
good that you put that up first.
absolutely. There's that old saying about the hand, and
Yeah.
So
well,
here we have some more recent blogs that we've produced in the scanning blog. A lot of great contributors, Franz, Alessio, just a tremendous community all pulling together to help our folks understand and apply the Wyckoff principles.
So do check out John's blogs, because there are a number of scanning lessons and examples of scans that can be done in his blog. So that's incredibly valuable. So with that, show us what you have for today, John. This is exciting. And I want to make sure we get in as much as we can in the time that we have.
Well, we'll get through everything that we can. So, scanning thoughts for a down market. We, of course, do have a down market. We've had some tremendous volatility. And we can ask ourselves, can we use these market conditions to explore some of our Wyckofian concepts? Effort, result, supply, demand, cause, effect. All of these things are in play at all times. How can we use this understanding, these laws, to help us find trade candidates, or even simply develop our Wyckoff skills? So for example, what would a Wyckofian say about the relationship of volume and average daily range, or volatility, in a severely declining market? If we thought of stocks that had both declining volume and declining average daily range, would those stocks be more likely to have found a bottom that could serve as support for a structure, or perhaps even an entry point to capture an automatic rally or quick recovery off of a low point? Conversely, what would we expect from a stock that has declining volume but increasing range? These are concepts that we use in Wyckofian scanning that you may not use in other types of scanning. Not that the other scanning isn't good, it's simply different. Let's take a look at some of the skills that we learned in part 1 of our course, and we'll be covering these in part 2, so you needn't be concerned about having missed part 1, but we'll go over visualizing price action, identifying technical conditions such as accumulation or distribution, and the events that are important to those. What events signal to us that we are in accumulation or distribution? We go over how to map price action, physically draw it out so that you can see and visualize and get right down on a piece of paper what you're looking for. We show how to go back in time using days ago syntax. We look at scan terms as directional or non-directional. Does this scan term presuppose a direction in price? We're going to cover that a little bit in the scans that we've laid out today. We're going to frame scans for price events that occur up and down or left and right. These give us unique structural perspectives on price that allow us to really zero in on price action that we're interested in. We'll look at widening the scope of scans, and of course, the watchwords for Wyckoff structural scanning: simplify, simplify, simplify. You do not need complex or lengthy scans to be very effective. And as always, remember, the best scan engine is between your ears and above your shoulders. That's the one we really want to work on, and that's the coursework and the power charting. All of that contributes to our ability to find the price action that we want to see. Let's take a look at our first scan. What if we looked for decreasing ATR, average daily range, and declining volume? So stocks that would decline in range have smaller daily ranges and declining volume. What would a Wyckoffian think of that?
Okay, so I mentioned ATR in the previous classes, or whatever you want to call this, probably a week at least ago. And I repeated it a couple times, several times in other topics where I discussed the beta, volatility, risk taking, or risk management, I mean. Yes. So I've mentioned what ATR is, so you shouldn't be surprised. I mentioned a little bit what EMA is. So that third line there where he's talking about EMA, if you don't remember what EMA is, forget about it. Just think of it as another type of moving average, because we already talked about the simple moving average, the SMA. But the most important thing is the ATR, average true range. So he's trying to measure the decrease in volatility, right? So that means the bars, the average size of the bars is shrinking. All right. Right. Anyhow, okay, Eric said, so is this pretty high level? Well, I mean, this level, I don't think so. I don't personally think so. I think there are people that are at a way higher level than this. And because this information is free. Any higher level of trading and information edge you get, you are not sharing to other people. All this stuff I'm showing you now, this just gives you the ideas, the seeds for where you need to be, because you need to build the base and from there develop your own trading system, investment system. And from that point on, you're on your own. Okay. If once you find that edge where you're consistently beating the S&P 500 or you're beating some kind of benchmark, if you're doing a day trade, you got to beat some, you have to have a goal to beat. You got to have something where you're saying, like, I'm making this much percentage per month or something. I'm making, and this over whatever other performance metric would be. I don't know how the day trader would try to compare to. Like, are they competing with each other or what? Because, like, let's just say I just made $100 for this trade and that trade, and I can't even like quantify how much I'm doing compared to someone else over time and taking into account taxes and things like that. Well, you got to have a benchmark. So we are trying to always improve. That's the goal.
Type of price action. Here's a very simple scan that would enable us to see what that type of price action would do for us. We're going to define these variables by looking at the average true range and the slope of a line, a 10-period line of volume. And then we'll rank these by their average true range. But we'll use the ascending feature on the ranking, meaning we'll go from smallest to largest. If you don't have the word ascending after your rank by, it goes from largest to smallest. So where does our concept come in of decreasing range? Well, we have a 10-period ATR is greater than its 5-period counterpart. So from the day you run the scan, 5 periods back, that ATR value is smaller than its 10-period big brother. If we want to see slope of a line, we can code that in to say, give us the slope of a 10-period exponential moving average of volume that itself is created on a 10-period basis. By asking that it be less than 0, the slope being less than 0 means the line will point down. Let's go ahead.
I mean, the standard benchmark is the S&P 500. Every hedge fund compares against that, and every technician compares against that. But when you're at a higher level of trading, you're probably just competing against each other at that point. So I don't know what they do, but at the most basic level, all you gotta do is show that your portfolio or your performance just outperforms the S&P 500. That's all it is. Now, if you're gonna compete with like someone like Stanley Druckenmiller, then show that you can at least gain 30% in your portfolio every year. Doesn't matter what. I mean, the S&P 500 could be going down and you're still gaining 30%. Now that's impressive, right? That's the impressive part. So all you got to do at the most basic level is beat the S&P 500. The best 500 US companies all grouped in an index. So it's designed. That's why most people, that's what they're told. Like you can't be the top guys. You can't be the best. Just buy the dip. Buy the dip at the S&P 500 and that's it. So if you live in the US, that's all you got to do. And most people around the world, they just do that too. So that's why the United States, you got the S&P 500. It's designed to go up. It's designed to go up. And that's why Denison, CKJ3, when they do their trading on futures and options, Denison only trades the ES, the E-minis. So that's it. Wait, my bad. I don't think he does that. I think he just does options on the SPY. He doesn't do E-mini options. So options on futures. No, he just does the options in the S&P SPY ETF. And then CKJ3 does futures trading on the NASDAQ 100. But that's pretty much similar to the S&P 500. So the NQ. So it's the NQ futures. So those things are designed to go up. So even if you screw up your trade, right? They just buy a dip, they get up. If they bought the wrong dip, well, they're out of luck, but hey, they can make it back pretty quickly because again, it's designed to go up. That's the goal. Yes, that's the goal. Is to beat the S&P 500.
And see what this scan would return for us. We get a whopping 2 stocks.
I do really appreciate how elegantly straightforward and simple that scan is, but also it points out that the volatility, using average true range to be able to tell the volatility and diminishing volatility, which is a measure of exhaustion of supply, absorption of stock, etc., is a classic Wyckoff concept, and how you're using that to reflect a classic Wyckoff idea. And so this I think is very exciting. It's very powerful.
Absolutely. Thank you, Professor. Here we have our 2 candidates. We see that our ATR 5 column is our last column. That's our sort column. It's going from the smallest to the largest because we asked for an ascending sort. That's the response that we get. We have 2 entries. This is our code in the form that it was actually run. And let's take a look at what these have produced for us in terms of chart action. Here is A Biomed, very well-known stock. We see that it's in a downtrend. This is our ATR comparison. So we see our 5-period ATR is indeed smaller than our 10-period ATR. And we see that this red line is our 10-period exponential moving average of volume, and we can see that that itself is descending. This chart would not on its face appear to be presenting a trade opportunity, but our main question and our first question after we run a scan is, are we receiving results that produce that are germane to our request? Are we getting what we asked for? Secondarily, we ask for what the chart is telling us about this particular stock and its viability for a trade. Here we definitely see somewhat of a troubled price move in a down channel. We've broken longer term support. Our relative strength is weak. The MACD is below zero, and our on balance volume is trailing off. So not a ton of positive things, may not be ready for an entry yet. And it probably is not a great short candidate either, because it is near the bottom of its channel, its down channel. Let's take a look at our second candidate, which is Under Armour, another big stock. Again, we see our 5-period ATR is less than our 10-period, very, very close, and our volume is moving down, although the recent trend, maybe a 5-day volume, would be increasing. The 10-period is decreasing. We see that this stock appears to have fallen out of a range in what is theoretically a significant sign of weakness. It's gone from 22 to 13.5 in a matter of 3 weeks. Great short, but if you wanted to go long Under Armour, I think you might have suffered some damage. So this particular scan has not produced much in the way of trading candidates for us, but we need to remember the first time we run a scan or we process a scan through our mind, that's not where we stop. Now we take a look at what the opportunities are to work with these concepts and produce more interesting results. For example, what if we scanned for stocks that have greater recent ATRs but have lower average volume and the market is declining? Note that when we scan for ATR and volume, we are not presupposing a direction in price. Price can escalate or go higher on each of those conditions. Similarly, price could go lower on those conditions. The directional feature in this scan is the market itself. All scanning is contextual. It occurs within the market. If all stocks are going down, chances are you're not going to find too many that are going up. And in this particular case, let's check with Professor Bruce to see what he thinks we should achieve in terms of results for stocks that have greater ATRs in recent past, but lower average volume.
Well, I think that what is possible with a scan like this is that if you have a increasing volatility against a declining market, it could be a sign of a stock or stocks that are beginning to show the ability to have say an automatic rally or new volatility in the opposite direction, potentially from the market. And so let's have a look and see what we might have here.
So here is our, oops, we jumped ahead a little bit. Here is our syntax for that particular scan. And what we've done is we've modified a single element in the scan. You've got the annotations from the prior scan, but note this term has changed, and that is the only change. That's one of the important points of scanning, is that incredibly and seemingly minor modifications for the scan code can produce dramatically different results. This is very, very important for troubleshooting scans, exploring different concepts, all very, very critical. Let's take a look at what this scan would do for us in terms of results. Here we have 8 scan return stocks. We again have our ATR going from the lowest to the highest. We have, these are the stocks, these are the sectors and industries. One of the important things, simply observe the scan results to see what's returning. Here, the majority of stocks are from the technology area. We also have quite a few from defensive sectors, food products and utilities, mobile telecom. So those are traditional defensive sectors. And we have seen in the market of late almost a little split personality with utilities and bond proxies increasing at the same time. Technology risk on stocks would be increasing. Very, very interesting circumstances. Let's see what these particular stocks look like on their charts. Here we have Norton LifeLock. It's done a fairly significant job of increasing in value for folks over the last quarter or two. And we look at whether or not our scan code has returned results that meet the criteria. Well, here our 5-period is ATR is now larger than our 10-period, so recent volatility is up. We do see that that's reflected in the lines. Certainly one point of scanning best practices, go ahead and calibrate your charts to display the results of your scans with the scan terms that you used as much as possible. So here we used ATR and we used the 10-period EMA of volume. Both appear on the chart, making it much, much easier to determine if you receive what you asked for. So we see that volume is consistently decreasing over time, and we have what may be the start of a snapback structure right here.
So we go from low volatility to high volatility and a reversal, and you can really see that in the both in the ATR indicator and then also in price. That's really powerful.
Absolutely. Let's take a look at our next chart.
And we have about 4 minutes left, so.
Absolutely. We'll get it in.
Yeah, you're doing great.
Kraft Heinz, deeply troubled stock over the last year or two, has certainly fallen out of a structure here, but we do see that its short-term ATR is larger than its 10-period counterpart. Volume is decreasing over a 10-period line, but a little bit more ambiguous. And relative strength is quite weak and downtrending. It's picked up a little bit of late, but still below its moving average. And nonetheless, we see something that resembles a hammer, wide bar to the upside on good volume, and an attempt to go down on a, I believe this was a particularly bad market day, is muted. So again, we may be receiving not only the results that we asked for, but results that are consistent with the way Wyckofians think about price, volume, and the relationship of the two.
And what we're really looking for with good scans is to have a list generated of stocks that we can then go in and evaluate with our Wyckofian method skills and be able to identify the best of breed in the scanning list that we have. So we're looking for quality lists that we can
Right. And we have what I believe is a personal favorite of Professor Bruce. We've talked about this stock before, and it's been in a number of power charting blocks. Professor, what do you see here?
Well, here's a great stock that appears to have resolved itself out of an accumulation type structure. It's now in a phase D, phase E uptrend and has had good jumps, increasing volatility, and now is consolidating in advance and appears to be in a reaccumulation type structure, preparing hopefully for another uptrend.
Fantastic. And again, the main point is, yes, Stock Charts has a wonderful, wonderful selection of scan criteria and the ability to process some very sophisticated scans with minimal coding. But the most important scan engine is the one that you bring to the table, your own mind and understanding of Wyckoff. So looking forward to working with folks in the upcoming special. Is going to be very, very dynamic. My hope is really to contribute to people's ability to find opportunity through scanning and understanding of the Wyckoff method.
And you can really see where scanning for Wyckoff is different from other scanning concepts. It's just a different approach, different way that we capture and use the change of information through the course of a chart maturing into say a new uptrend from accumulation or distribution, et cetera. And so we have about 30 seconds left. Ramon, any last thoughts before we're done?
Sure. And as I was looking at the last two charts that were shown, I think it's very important for the viewers on those charts to see the context of the specific scan and what is the context. In one chart it was to the upside, and another it was to the downside. So it's extremely important to understand that as well.
John and Ramon, thank you so much for being on the program. We really look forward to your workshop and for you to come back again and continue to discuss these very powerful concepts. Thank you both.
All right, so almost 3 hours. So perfect timing once again. And yes, I encourage you to read your homework. You got tons of stuff. You can look at the structural scanning blog too. So in addition to the homework, go to that website. But yes, read the resources, read that homework stuff. Once you understand the Wyckoff stuff, we'll start moving on to more advanced scannings. I'll introduce my own ideas of how to scan for portfolio management, and then we're going to use the Wyckoff stuff to try to scan, and also the multi-time frame things I also introduced a couple times this week to look for opportunities for swing trading. And then we can apply these things to even more fine grain, look for day trades, potential setups, So we can use the higher level stuff to look at sectors and things, but also use them to find opportunities where, like, okay, if this stock is in a good sector, try to look for short-term conditions where it looks like, oh, this is going to pop off, right? So we're also in a good sector, we're in a good industry, we're also looking at the multi-time frame, the charts look good in that sense, and then we're looking for the trigger at the lower time frame. In addition, we can also use cycles to do this, because I didn't discuss too much about the intraday cycle analysis, that these tools are being built as I speak by the Foundation of the Study of Cycles. So there's a lot of people doing many different things now, and we also have AI around the corner. So yes, if you have the knowledge, it's now about applying the knowledge. Just having the knowledge isn't good enough. Actually putting it to work with all these tools we have in the computing age, the AI age, there's no excuse anymore to make money in a more sophisticated manner than people in the past, because these ideas are old. The Wyckoff ideas are old, cycle ideas are old, but the difference now is the tools are different, more advanced, and you also have more opportunities to look at thousands upon thousands of stocks. And now we have crypto too, right? A new asset class is coming. So we'll have hundreds of cryptos to even have to analyze at the same time. So anything with a chart that can be traded is an opportunity to make money. So, all right, guys, good night. Maybe I'll come on during the weekend to show you some more things about scanning, because I think it's a very important topic as we move on to November, when things get really, really crazy. So prepare for next week's earnings, and then from there we can move on to more advanced topics as the volatility increases in November, and that will set the stage for next year in 2025. So by 2025, you should be really, really well prepared to deal with anything that happens. Okay, good night. Good night. Oh, and remember, Halloween, you got to donate. Please donate. Please donate to the pot. I think we're still at 655 unless someone else has been donating the past couple days. I'm not sure. But yes, you got to get to the pot and put up the banner to close out the show. Yes, the Haunted Hotties Halloween Beauty Battle. So let me get rid of the comment there. Yes, October 31st, 9 p.m. Central, 10 p.m. Eastern. 13 women will compete. Enter to win. All right, at the Urban Landlord. All right, guys. Good night.